there was a revaluation gain or basically whether there was a revaluation what? Loss. So we need to determine whether there was a revaluation gain or a revaluation what? Loss. And basically, how do we determine that? We have to compare two values. We compare the revalued amount and the carrying amount, and the carrying amount, and the carrying amount, and the carrying amount. Now, is my video clear? Someone is saying my video is not yet clear. Video iko sawa? Video iko sawa? I can see someone with saying the video is not okay. Is it John? Okay, yes, I'm told my video is clear. I'm told my video is clear. I'm told the video is clear. So John, check what is happening. You can log, you can exit, then you rejoin, log out and then log in. So we see whether there will be some improvement. Yes. So in that particular case, we are saying this is an item of PP which was revalued. So what we need to do basically is we determine the revaluation gain. So this one is quite simple. So we just compare the revalued amount, So this item was revalued at an amount of 2,500 million, and then you're given its carrying amount. Remember, the carrying amount of an asset is the same with the net book value. So the net book value is 1850. So basically, in this case, you can see this item was revalued upward with an amount of 650. So this 650 is what? Is a revaluation gain. And remember, you say that this particular 650, this one should be accounted for as part of the other comprehensive income. Being part of the other comprehensive income, this one should be added to the profit for the year. Yes, but remember there was a deferred tax to be computed on this. Let's go to the last paragraph of note 2, and you're told the directors do not make any inter-reserve transfer upon revaluation. However, they do account for the deferred tax on the revaluation of property, plant, and equipment. Revaluation is yet to be accounted for in the books of the bank. So basically, this company, we are told, accounts for deferred tax on the revaluation. So if you equally, you can be able to recall what you did in financial reporting. You are told anytime the company has revalued an item of PPE, there is a revaluation gain. We compute something called the deferred tax on revaluation gain. So how do we compute that deferred tax? The deferred tax on revaluation gain. So the deferred tax on the revaluation gain, this one is computed by taking the revaluation gain times the tax rate, So the revaluation gain is 650, and then tax rate. We have it in note number 3. Note number 3, the last sentence. Basically, we are told the applicable tax rate is 30%. So this was giving us an amount of how much? Was it 165? 185 million. Yes, 185 million. So how do we account for this? We say that this one is basically accounted for by debiting the revaluation reserve account. To debit revaluation reserve is basically to reduce. Now, we say that this particular amount here, which is the revaluation gain, this one should be debited in the PPE, credited in the revaluation reserve. It should be added to the PPE and then added to the revaluation reserve. But because there is a deferred tax associated with it, then we say that we will have to reduce this with an amount of 195. To debit revaluation reserve means we need to reduce that with an amount of what? 195. And then this one we say should be credited in the account which is called the deferred tax account. The deferred tax what? Account. So therefore, this particular revaluation gain here, the revaluation gain, which you're going to recognize in the income statement as part of the other comprehensive income, has to be net of deferred tax. So therefore, we will take the revaluation gain, which is basically 650 million, 650. Then we are saying we debit the revaluation reserve. To debit is to reduce this. We deduct it from this, which is basically 195. And this was giving us an amount of how much? For something, For what? What is the net amount? 650 minus 185. Yes, so this one will give us 455 million. So this one is what we will recognize in the income statement as part of the other comprehensive income. the revaluation gain, but it has to be net of the deferred tax. And then when preparing the deferred tax account, this particular amount would be credited there. That should be the double entry for that revaluation, for that deferred tax or the revaluation gain. We deduct it from this amount, and then when preparing the deferred tax account, we credit it there. So we are done with that point number 2. Let's move to point number 3. In point number 3, this basically was examining something to do with the income taxes. There is a full topic you're going to do in relation to that, no need to worry. So we are told during the year, which ended 31st of March 2022, the current tax on profit was estimated to be 890. So this is basically the current tax, which is basically 890. So if you can be able to recall what you did in financial reporting, so usually this particular item here can only be adjusted with something called the over provision or under provision of current tax from the previous year. I hope you can be able to recall. If, for example, there was any other provision from the previous year, we add it here, under provision of current tax from the previous year. But if there was an over provision basically should be deducted. Over provision of a current tax. So that is the only adjustment which we make to the current tax. So any other provision of current tax from the previous year, we add it here. Any over provision, we do what? We let it. Let's move to the other sentence. We see whether there is such over or under provision. In sentence number 2, we are told, as at 31st of March 2022, the carrying amount of the net asset exceeded the tax base by 1,800 million. This carrying amount does not include the effect of the revaluation in note number 2. The income tax applicable to this company or to this bank is what? Is 30%. Now, that information which are given there is basically to help us to compute something called the deferred tax. The deferred tax. So meaning that in our case here, we don't have any over or basically what? Under provision. So now what you're told from sentence 2 is that the carrying amount of this bank's net asset exceeded the tax base with an amount of 1,800 million. So we said the first thing you need to recall is the name given to this difference. The name given to the difference between carrying amount and tax base. And this is something you also did in financial reporting, and you're told in that topic of income tax, in that topic of deferred tax, you're told any difference between the carrying amount or the difference between carrying amount and tax base of asset liabilities or basically net asset, that one is called temporary difference. Temporary difference is the difference between carrying amount and what? And tax base. And equally, we are told that we have 2 types of temporary difference. We have the taxable temporary difference. We have the deductible temporary difference. That is something you need to recall. Now, a temporary difference we say is taxable, whereby the carrying amount of the net asset exceeds what? The tax base. And basically this give rise to something called the deferred tax liability. So anytime you come across a question and basically you told the company had a taxable temporary difference, you need to compute the deferred tax liability. Remember, these are taxes to be paid in the future. How do we compute this one? We take the taxable temporary difference, this one, and basically multiply that with what? With the tax rate. Now, on the other hand, a deductible temporary difference arises whereby the carrying amount is less than the tax base. Remember, this should be tax base TB than the tax base. And basically, this give rise to something called the deferred tax asset. How do we compute the deferred tax asset? We take the deductible temporary difference times what? Times the tax rate. So therefore, what we are expected from this, from that point, is for us to determine whether this amount here, which you're seeing is a temporary difference, is it taxable or deductible? In our case, because the carrying amount is more than the tax base, automatically is what? Taxable. So taking into account it is taxable, we will use this to compute something called a deferred tax liability. But still, there is something which you are told in that particular point number 3. I think it should be sentence number 3. We are told this carrying amount which exceeded the tax base with 1,800, this carrying amount does not include the effect of the revaluation in note 2. Remember, once the company revalue assets, that does not affect the tax base. Remember, tax base is the value we use to compute the value of an asset used in taxation. So the value of an asset usually in taxation is always based on the cost. If you revalue an asset, does that affect the value used in computing the carrying amount? Not the carrying amount, sorry, the capital allowances? No. So we compute the capital allowances, which is allowable expense in tax using the cost. So, but anytime you have revalued an asset, that affects the carrying amount, the value at which an asset is recorded in the balance sheet. So therefore, these particular assets which were revalued upward, definitely that was supposed to increase the carrying amount. But we are told this particular difference which are given here does not include this increase in what? In the carrying amount. That's why we say we will take this particular amount by which the carrying amount exceeded the tax base, and then we have to add this because this one was not captured in computation of this. So therefore, the correct figure for the company's taxable temporary difference will be 18 million plus what? Plus 650. Plus what? 650. And this was giving us 24 what? 50 million. So this is what? These are taxable temporary difference. So what we need to do is to compute the deferred tax liability. So the deferred tax liability would be equal to the taxable temporary difference times the tax rate. So the taxable temporary difference is this one, 2450 times what? The tax rate, which is 30%. So what will be the deferred tax liability at the end of the year? The deferred tax liability at the end of the year, yes. So that one would be 735 million. Now remember, in preparing the statement of financial position, this is basically what we recognize there, and this is a liability. The deferred tax liability is what? Is a liability. But now there is also something we need to do. We need to prepare a deferred tax account so that we determine the amount of deferred tax to be charged in the income statement. So how do we prepare the deferred tax account? We are going to use certain basically a number of items from here and also from the balances we have below paragraph 1. So this is the deferred tax account. The deferred tax account. Now, what do we start by recording here? Remember, whatever you have here, this is the deferred tax at the end of the year. This year ended basically on 31st of March. 31st of March 2022. That is the deferred tax at the end. That's why we are saying that what we are going to recognize as a liability in our balance sheet. Now, when preparing this account, we always start by recording the deferred tax at the start. Now, if we go back to the balances we have below paragraph 1, somewhere in the middle there, we are given the deferred tax at the start. And you see the deferred tax from those balances we have below paragraph 1, we can be able to see that item of deferred tax. Yes, can you be able to see that deferred tax? The deferred tax? Yes. Deferred tax, somewhere in the middle there. Yes, the deferred tax of 370. And actually, in this case, you can see the question is silent, whether it is a liability, whether it's an asset. If you're given a deferred tax, the question is silent, then we always assume it is a liability. So this one we treat it as what? A deferred tax liability. Being a deferred tax liability, we will record that as the opening balance here on the credit side. Remember, all liabilities have a credit balance. I've said if the question is silent, you assume it is a deferred tax liability. It is a deferred tax what? Liability. Now, after recording that, what else do we record in this particular account? The other item we record in this account is the deferred tax at the end of the year here. Now, this being a deferred tax liability, the balancing figure or the balance carried down should be recorded here. Such that after balancing our account, because this one is a liability, the balance brought down will be a credit balance. Remember, this one is a liability. Yes, but carried down should be on the debit side if it is a deferred tax liability. If it is a deferred tax asset, carried down should be on that side. Now, what else do we record here? The other item which we record here is this item here, 185. We said 185 will be credited in the deferred tax. And that, remember, is the deferred tax on revaluation gain. On revaluation what? Gain, which is basically 185. 185. After recording that, if you can be able to recall what we are doing in a file, the balancing figure in this account should be taken to the income statement. The balancing figure in this what? Account. So if the balancing figure is on this side, that one we take it to the income statement, and this one we refer to it as a deferred tax expense. if the balancing figure is on that side, is a deferred tax expense. If the balancing figure is on this side, still, it will be taken to the income statement. That is the deferred tax income. Is the deferred tax what? Income. And I think we will be having a balancing figure on the credit side. So what will be the balancing figure on the credit side? Should be 735 minus 370 minus 195. And basically that will give us an amount of how much? An amount of 170. So what is that? It is a deferred tax expense. Remember, being a deferred tax expense, this one together with the current tax, those two items will be deducted from the profit before tax. So from the profit, or actually, once we get the profit before tax, we less the income tax expense. Income tax expense comprises of the current tax and the deferred tax expense. Sasa, yes, I think having that now we can be able to move and basically prepare what is required. Prepare what was required. So actually, what the examiner did in relation to this question, he tested the student's knowledge on a number of standards, because what was tested here in relation to this point is the student's knowledge on International Accounting Standard number 12, income taxes. Here, the examiner was testing the student's knowledge on IFRS 9, financial instrument. We will do something to do with that. We will do something to do with that. And what the examiner was testing here is the student's knowledge on IAS 16. IAS 16, remember, is on what? IAS 16 is on what? Who can be able to remember? International Accounting Standard number 16, from what you did in a FA, what you did in a FAN, is on what? IAS 16. Who can be able to remember? IAS 16. Remember, knowledge on this standard moving forward now is very, very important. Equally nowadays, if, for example, you go to an interview as an accountant, you may be required to mention a number of standards, because as an accountant, you're expected to have some knowledge on these accounting standards. Yes, it's very, very important. Even if you don't have detailed information about these standards, you need to know. For example, when we talk about IAS 16, it is on what? It is on PP. When we talk about IAS 12, it is on income taxes. So these are some of the questions you're likely to encounter nowadays once you go for interviews. Yes. So let's basically move and start with what is required in part A, and that is basically the income statement of profit or loss, statement of profit or loss, and other comprehensive incomes. Other comprehensive incomes, basically for the year, which ended 31st of March 2022. 31st of March 2022. So here we just need to have a single column, and our figures are in million of shillings. So what do we start by recording here? We start by recording the interest income. So we say this format is very, very important. We start by recording what? The interest incomes. The interest incomes by our bank. So if we go back to our question, basically we have a number of interest incomes somewhere in the middle of the balances we have below paragraph 1. So number 1, we have the interest on loans and advances to customers. So this one is an interest income. We said once you go to your bank, you take a loan, you are charged an interest. So the bank is an income. So we just say that this is the interest income from loans and what? And advances. Advances to who? To customers. So no adjustment for that, which is basically 25.75. Then below that, we have interest on government securities. On government securities, which is an amount of 264. Then we also have interest on deposit with other banks. Deposit or interest on deposit with other banks. Other banks. So basically that is an amount of 646. And then the interest on deposit from other banks. Interest on deposit from other banks. So remember this basically deposit which is held by our bank here, and those deposits belong to other banks. So our bank here, that is Delta, is paying other banks interest. So this one is an interest expense. So then we have the interest on customers' deposit is an interest expense. We have interest on long-term borrowing is an interest expense. Yes, and I think those are the only interest incomes which we have. We don't have any other. So let's get the total interest incomes. The total interest incomes. total interest incomes, we get an amount of how much here? Uh, 54, 54.85, like that. Yes. So and then to this now we proceed and we less the interest expenses. The interest expenses. Interest expenses. Now for the interest expenses, equally we have a number of interest expenses. We start with where we have the interest on deposit from other banks. So the interest on deposit from other banks. Deposit, interest on deposit from other banks. From other banks. So basically that is an amount of 662. We record that here as a negative because we will deduct that from that total. So below that we have interest on customers' deposit. On customers' deposits. Customers' deposits, which is basically an amount of 18.33. Then from there we have the interest on long-term borrowing. On long-term borrowing. So that particular interest is an amount of 13.85. But remember, we say that this particular interest on bonds, remember bonds is a form of a long-term borrowing. Anytime a company, anytime a bank issue bonds, that is a form of long-term borrowing. So the interest on this bond basically will have to be included there. That is this interest of 54. We also include it as part of interest on long-term what? Borrowing. So we add 54 there. We add what? 54. And that will give us a total of 19 what? 1939. 1939. After adding the interest on both, are we getting that value? 1939. I've taken the interest on long-term borrowing, 1385, plus this interest on the board. I've said the board is a form of long-term borrowing. Yes. So I think that would basically we have. We don't have any other interest expense. I can't see any other interest expense. I can't see any other. I can't see any other. So what we get here is the net interest incomes, or net interest income. Net interest income. So we take whatever you have here, we less those three interests, those three interest expenses. We less those three interest expenses. What do we get? What do we get, John? What do we get, Timothy here? What do we get, Henley? Charles, what are you getting? 1551. 1551, yes, 1551. So after getting that in net interest income, we said we proceed and we add the non-interest incomes, the non-interest incomes, non-interest income. So the non-interest incomes, these are basically other incomes by the banks other than the interest incomes. And long-term borrowing is not correct. Which figure are you saying is not correct? Is that the figure for 1939? Huh? Oh, okay. Sawa. It should be 14. Okay, sawa. But I hope this one is correct. But I hope 1551 is correct. Okay, sawa. Thank you. So which non-interest incomes do we have? So I think we can get that from where we have below the interest incomes and interest expenses. We have administrative expense, other operating expenses, and then below that we have fees, commission, and foreign exchange incomes. So we have fees, commissions, and forex incomes. So remember, you say these forex exchange incomes. This is basically the profit which the bank, the income the bank get from buying and selling foreign currencies. We refer to that as foreign exchange income. And I don't think we have any other than that. I can't see any other, including up there. I can't see any other. I can't see any other. So we get the total the total incomes, and then we less the non-interest expenses. Non-interest expenses. So this will give us a total of 76.41. Then next we less the non-interest expenses. Non-interest expenses, I think above this, fees, commission, and foreign exchange incomes, we have two expenses. That is two non-interest expenses. So we have administrative expenses. Administrative expenses, which is an amount of 2160. And then we have other operating expenses. Other operating expenses. And the other operating expenses is basically an amount of 1163. 1163. I can't see any other. I can't see any other, including what we have in the additional information. Yes. So let's get now the profit before tax. We get the profit before tax. The profit before tax. What will be the profit before tax here? 43.18. 43.18. That is the figure I'm getting. That is the figure I'm getting there. Someone to confirm whether that figure is correct. Okay, sour. Now to this, we need to less the income tax expense. The income tax expense. So the income tax expense, this comprises of two components of tax. Number one, this comprises of the current tax, which we have here. Basically, note number 3. Note number 3. So this one, 890. And basically, someone may ask, within the balances we have below paragraph 1, there is somewhere we given installment tax paid. I don't know whether you can see that. There is somewhere we given installment tax paid, just above the deferred tax. Now, this installment tax paid, generally, I hope you know how companies pay tax. Company pay tax not at the end of the year, but basically a company should estimate the tax to be paid at the start. There is some guideline issued by Revenue Authority on how to estimate the tax to be paid in a certain financial year. That tax has to be paid in 4 installments, in forward installments. So therefore, like this, the tax for 2022, most of it basically was paid within the current year. Like 3 installments were paid during the current year. The remaining installment will have to be paid in 2023. So therefore, that installment tax paid will help us in terms of determining how much tax has not been paid at the end of the year. So you can see our company here was supposed to pay a tax of 890 during the current year, because current tax is the tax to be paid in relation to the profit for the current year. In relation to the profit for the current year, this is the tax which is supposed to be paid by the company during the current year. But now, at the end of the year, our company had paid installment taxes amounting to 360 million. Amounting to 360. So the difference here, this is the tax not yet paid. Or in other terms, you can say it is accrued what? It is the accrued tax. Being the accrued tax, this one will be a liability. This one will be what? This one will be a liability. Yes. So what I'm saying is that companies do not pay tax once the year comes to an end. So a company should estimate the tax will be paid at the start of the year. And then that tax has to be paid in 4 installments. I hope this is something you know from tax. So that's why I'm saying during the current year, our company was supposed to pay a tax of 890, but when the year was coming to an end, out of this 890, the company had already paid 360. So what we account for here is not the tax which had been paid. Remember, when preparing the income statement, we prepare this on accrual basis. Whatever you capture here is the expense for the current year, not what was paid. The expense for the current year. Our company was supposed to pay 890. That's what we captured here. But when the year was coming to an end, the company had already paid 360. So the balance, which is around 530, is the current liabilities, what had not been paid. That will be paid in 2023. We will account for that as a liability. Yes, but basically what we account for here is the tax for the year. I hope that point is clear. I hope that point is clear. Now having such, we can proceed, and basically we also account for the deferred tax, because I say that this income tax comprises of the current tax and what? And the deferred tax expense. The deferred tax expense is what we computed here, this particular amount here, the amount of 170. The amount of 170. So that is basically what we captured here. And then we get what? We get the profit after tax. The profit after tax. So how much will be the profit after tax? The profit after tax. $32.58, yes. So after getting that, we proceed and basically we add other comprehensive incomes. Other comprehensive incomes. So remember, other comprehensive incomes, these are the other incomes which should not be part of this profit. They should be added to the profit after tax. Yes. So, and I think in our case, we only have one item, this revaluation gain, but we said we will record it here, we will recognize it here net of deferred tax. And I think we computed that amount to be recognized here, and it is that amount. So we have the revaluation gain on property, plant, and equipment, which was basically 650, but we deducted the deferred tax. So this one, therefore, will be recognized here net of deferred tax, 455. So we don't have anything else. We get the total comprehensive what? Incomes. Total comprehensive incomes here will be 3. 1. We should get 7. 37, 13. 37 what? 30, 37, 13. Yes. So that is it. That basically what is required as far as that question is what is concerned. Now, because of our Muslim brothers, I want to give you a short break of just 10 minutes. We come back and then we finish on what is remaining. We just take a short break of 10 minutes. We come back and then we prepare the statement of financial position. Sasa? Yes. So we take that short break. Yes. So I want us to continue. I hope you're back. Let's continue. Let's continue. Are you back? Are you back? Are you back? Are you back? Please confirm whether you're back. Okay, sawa. So let's finish basically by preparing what is required in part B. So in part B, we are required to prepare the statement of financial position. So this one basically we record assets, liabilities, equity of the bank, and always we start by recording the assets here. So this will be our part B, our statement of financial position. And basically this is at 31st of March 2022. 31st of March 2022. Yes, so we start by recording assets. And remember, in this case, we said when recording assets of a bank, we don't classify them. So the rule is that we should record these particular assets in the liquidity order. We start with those assets which are either liquid or highly liquid. And finally, we record those assets which are least liquid. They cannot be converted into cash within a short period of time. So that is basically the rule here. Yes. So which are the assets, or which asset do we start with? I think we will basically start with the first item given below paragraph 1, and that is the cash and balances with central bank. Cash and balances with the central bank, which is basically 46. So then from there we have money on demand, and the short-term deposits, which is basically 21.50. Remember, you say that this is basically the amount of cash which is held by the bank to meet the customer's deposit. If you go to your bank, you want to withdraw some cash, the bank basically uses this to meet your withdrawal demand. So it's basically a cash. So then below that, we have deposit with other commercial banks. We have deposits with other commercial banks. Basically, that as an amount is an amount of 46. an amount of 46, an amount of 46. Because of space, we have to do away with this one. Yes, so then below that we have deposits from other commercial banks. Deposit from other commercial banks, this one is a liability, that's what we know. Then from there we have investment in government securities is an asset. Investment in government securities. In government securities, which is basically an asset, 4485. Then from there we have investment in equity instrument. So this is basically investment in shares, which is still an asset. Equity instrument, which is an amount of 765. So then from there we have property, plant and equipment. Property, plant and equipment. But this one will have to be adjusted as per note number 2. So we will take the amount of 7416, and then to this we add the revaluation gain. So the revaluation gain. So the revaluation gain basically is this amount. So we are not adding that here net of deferred tax, because you can see that deferred tax of 185, there is nowhere it is affecting PPE. So it's only supposed to reduce the amount to be taken to the revaluation reserve account, but it's not affecting this. So we add 650 there. So that will give us a final value of what? A final value of 80 what? 8066. Yes, 8066, like that. So below PPE we have intangible assets. Any adjustment for that? None. So you have intangible assets. Intangible assets 4986. No adjustments. So then from there we have loans and advances to customers. To the bank, this one is basically an asset. The loans which are given to customers, loans and advances to customers. That one is basically an asset. So then from there we have customers deposit. Customers deposit to the bank, this one is a liability. Then we have long-term borrowing is a liability. Below that we have other receivables, which is still an asset. Other receivables. So other receivables is an amount of 2493. Then we have other payables is a liability, installment tax. That is not an asset. Okay, down there I can see what ordinary share capital deposit. Yes, we don't have any other item of assets. What about the additional information? We have dealt with note 1 will not affect asset. Note 2, we have made adjustment for that, equal note 3. So I think in our case we are done with the assets. So let's get to the total assets. I'm told by Naitari will be 39. 39. What? 735. 735. Someone to confirm whether that is the value you're getting. Confirm whether that is the value you're getting. Is that what you're getting is the total assets? Yes, confirmed by Charles. So from there, we double underline that, and basically we move and we are called equity. Equity, which is basically share capital and reserves. Share capital and reserves. So we will start with the ordinary share capital. Ordinary share capital is just downstairs below interest incomes, below interest expenses. We have ordinary share capital. Basically, no adjustment for this. That is an amount of 44. So below that, we have share premium, equally no adjustments. Share premium, which is an amount of 25. Then we have the deposit protection reserve. Deposit protection reserve. Reserve, equally this one will not change because there was no any amount which was transferred to that reserve, which is basically 5,000. Then from there we have the retained earnings. the retained earnings. So the retained earnings, this one, we take the retained earnings given here, which is basically an amount of 3623. So remember to this, we need to add the profit for the current year. Which profit do we add here? We basically add this profit after tax, not the other comprehensive incomes, but basically we add the profit after tax. The profit after tax is 3258, this one. Yes. Now, there are some questions you may come across whereby equally you're given some dividends which were paid to the shareholders, not the proposed dividends, but dividends which were paid. In case you come across a question whereby there are some dividends which were paid, the dividends we know are paid from the profit. So those dividends which were paid, let them fair. But in our case, we don't have dividends which were which were paid. So what will be the net amount? The net amount there, 3623 plus 3258. I'm given what? I'm given 6881. 6881. Yes. So that is what we have. And then below that, we have suspense. Remember, suspense, we were told as per note number 1, basically related to this board there. That's suspense of 414, because we were told what our company had accounted for. Our company had accounted for this 450 and this particular amount of 36. And I think I've explained how we had computed. This amount was arrived at. It was 450 minus 36. So, but basically we said what the company or what you're going to account for here is the amortized cost which we computed here, and I think with the interest which we computed here as an expense. Yes. Now, do we have any other component of equity here? Yes. Recall, this bank revalued some items of PP. There was a revaluation gain of this, but we said that one we recognize it here, net of the deferred tax. Net of the deferred tax. So we will have a revaluation reserve. The revaluation reserve, which is basically this one minus deferred tax, minus the deferred tax. So 650, we minus the deferred tax of 185. So whatever you recognize here has to be net of deferred tax. That is 455. It has to be net of the deferred what? Tax. It must be net of that deferred tax. It has to be net. Do we have any other component of equity? I can't see any other. Can't see any other. So let's get the total equity. Let's get the total equity. The total equity. The total equity. So actually, this was a very, very good question. A very, very good question because it tested so many concepts. It was a very good question here. 19,236. 19,236 like that. Yes. So then from there, we basically move and we record what? We record liabilities. We record liabilities. Now, for liabilities, equally recall, we don't classify the liabilities into non-current and current. Yes, we don't classify the liabilities. So where do we have liabilities? So liabilities, I think we can start up there from where we have deposit from other commercial banks. Deposit from other commercial banks. Deposit from other commercial banks. This one is basically a liability from other commercial banks. That's 324. So then we have investment property, intangible, loans and advances. And then from there we have customers' deposits. Customers' deposit, this one is equally a liability. Once you have some deposit with your bank, to you it is an asset, to your bank it is a liability. So the customer's deposit is 7065. 7065. So then from there we have long-term borrowing. Long-term borrowing. Now this long-term borrowing equally, we have to adjust that with this both, because this both I say is a form of a long-term liability, is a form of a long-term borrowing. So we will take the long-term borrowing which are given there, which is an amount of how much? An amount of 5660. And then we add the amortized cost. The amortized cost of the board. The amortized cost of the board is this one. 468. 468. So that will give us a total long-term borrowing of how much? The total long-term borrowing. Total long-term borrowing You're getting what? Yes, that one should be Henry. Is that correct? 6128. 6128. Yes. So we have that. Then we have other receivables below long-term borrowing, and then we have other payables. Other payables. So other payables is an amount of 2717. So then below that we have installment tax, and basically we said that that particular installment tax will be used in terms of computing how much tax had not been paid at the end of the year. So remember, this company we know, as per the information we have in note number 3, our company was supposed to pay a tax of 890 million. This is the tax which was supposed to be paid in 2022. But our company had paid installment taxes amounting to 360. So the difference is what had not been paid. We can just refer to that as the current tax payable. The current tax payable, 890 minus what the company had paid. Minus what our company had paid. So the difference is what had not been paid, which is 530. Is it 530? Yes, 530. So then from there, below the installment tax, we have the deferred tax. Remember, the deferred tax which we recognize here as a liability, the deferred tax which we recognize here should be the deferred tax liability at the end of the year. So how much is the deferred tax liability at the end of the year is what we computed here. This is the deferred tax liability at the end. Basically, that is what we recognize here as a liability, not at the start, not this one, and not that one. The deferred tax liability at the end. So 735. So what else do we have here? I can't see any other item which you have not captured below as per the information you have below paragraph 1. What about in the additional information? Note 1, we have dealt with these boards. Note 2, note 3. I think we are done. So let's get the total equity and liabilities. Total equity and liabilities. Total equity and liabilities. So you add all these. Add all those. Yes, so I'm told that that one will give us 30, 39, 735. 735. Yes. So that is it. That basically what was required in that question is a very, very good question on financial statements of a bank. And because the question you can see is very much comprehensive, is not shallow like the other one which we did. A very comprehensive question. It has tested so many concepts here: deferred tax, the concept to do with IAS 16 PPE, how we compute the deferred tax on revaluation gain. We will come across some of these topics in that some of these concepts in the other topics we will be able to do what to discuss. So it was a very, very good good question on financial statements of a bank. So basically that is it. That brings us to the end of that topic. So and actually we don't have any other questions. So those are the only two questions. The only two questions coming from that topic. So what we'll just need to do is maybe try to redo them afresh. Make sure that if you happen to come across a similar question in an examination setup, basically will be in a position to prepare those financial statements as required by who? As required by the examiner, as required by the examiner here. Yes, and because we have like some few minutes here, we can have an introduction to another topic.
We compute the future value of an investment, how we compute the present value from a future value, and some other illustrations. So let's start with the August 2024 question 2B. Let's start with August 2024 question 2B. August 2024 question 2B. So from your past papers, please have that. August 2024 question 2B. That is the question we are starting with. Are you there? Now, are we looking at part B of that question? Now, before we look at part B, look at part A. Part A says, describe 3 types of money market instruments and their related transactions available in the financial system. That is from topic 2 that we covered. And we talked about the money market. Money market, remember we said is the market for short-term funds. Market for short-term funds. So there you find treasury bills, you find commercial papers, promissory notes, and the rest. They are there in the handout that I shared. So let's go to part B. I want, if possible, we do away with this topic today. So I want us to move a bit faster, yeah? So part B, Samuel Mongeka intends to invest shillings 200,000 at the beginning of each year in treasury bonds, which earns a return of 9% per annum. So Samuel Mongeka intends to invest shillings 200,000 at the beginning. At the beginning is very important. At the beginning of each year in treasury bonds, which earns a return of 9% per annum. Required, determine the accumulated value of investment after 10 years. So remember, this person, we're being told that this person will be investing 200,000 at the beginning of each year for a period of 10 years at an interest rate of 9%. So the 200,000 is an annuity. 200,000 shillings is an annuity in this case. So you say annuity. So this is part 1. So annuity is 200,000 because this is happening each year. So it becomes an annuity. Then the interest rate is 9%. 9% per annum. 9% per annum. The required, that is investment after 10 years. The number of periods is 10 years. So he's going to invest for a period of 10 years. This is an annuity due because it is occurring at the beginning. So present value of annuity due, we said is equals to the annuity times. So here we can choose to use we can use the tables or we can use the formula, whichever you want. So 1, let's use the formula for this one. 1 minus 1 plus R. Now we want the future value. We're looking at the future value. So yeah, we are computing the future value, not the present value. So 1 plus R power n minus 1 over R times 1 plus R times 1 plus R. That is the formula that we said for future values. So yeah, so we are going to change here. It's not present value, it's the future value of an annuity, because we are looking at the value of the investment at the end of 10 years or after a period of 10 years. So, and I want to believe we are together. Are we together? So let's proceed. So here we say, the annuity is 200,000 times 1 plus 0.09 power what? Power 10 minus 1 over 0.09 times 1 plus 0.09. So from that, we can get the amount. Get me that figure kindly. You're taking too long, kindly. Yes, you're getting 33, 120, 33, 120, 58.68. So it's what? Sorry. So this is here. It's 3 million. Okay, fine. So that must be the correct answer. That must be the correct answer. So the keynote here, it's the beginning. Remember the question says at the beginning of each period. And that is why we are having this factor here, 1 plus R. So take note of that. Then next part B, not part B, but part 2. Determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So here, they're saying, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per annum. So again, this is still an annuity. And this annuity, they're saying, it is 1.2 million that is payable annually for a period of 20 years. So here we will say the annuity is 1.2 million. 1.2 million payable for 20 years. The period is 20 years at an interest rate of 8% per annum. Interest rate is 8% per annum. And we're looking at the present, determine the present value of shillings 1.2 million annuity payable for 20 years at an interest rate of 8% per. So they have not said whether the amount is at the beginning or as at the end of the period. So when the question does not specify when the payment is being done, it is assumed to be an ordinary annuity. So this is an ordinary annuity where the payment is occurring at the end of each period. So present value of annuity, which is an ordinary, we said is equals to the annuity times 1 minus 1 plus r power negative n over r over r over r. So this is 1.2 million times into brackets 1 minus 1 plus 0.08 power negative 20 over 0.08. So get that. Get the present value. Get me the present value kindly. I'm waiting for the answer. Hilda? Eleven 781 720. Eleven 781 776. Point 89. Let's say 89. So that is okay. That is how we get the present value of an annuity. So you can see, these are the same things that we were looking at during our classwork. What you need to do is to get the concept. You need to understand what you are computing, what information has been provided. Have I been provided with an annuity? Have I been provided with a lump sum? And things like that. Let's have another question, a quick one. December 2023. December 2023. December 2023. Question 3. C. December 2023, question 3C. for December 2023, question 3C. Are you there? Yeah, question 3C say, no. This is on loan amortization, yeah? This is on loan amortization. December 2023, question 3C and D. Let's do part D. Let's do D, not C, D. We are coming back to part C on loan amortization. So let's have it somewhere. Question 3C. It's on loan amortization. So let's look at part D. Says, 𝐎𝐍𝐋𝐿 has the following investment options to choose from. 𝐎𝐍𝐋𝐿 has the following investment options to choose from. Post office MIS scheme, monthly interest, 8% per annum. ICD bank deposit, quarterly interest, 8.25% per annum. HDFC Limited have yearly interest, 8.5% per annum. Required, using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option using the effective interest rate. So remember, we said effective interest rate. Effective interest rate, it is adjusting the nominal interest rate with the number of times compounding occurs in a year so as to get an interest rate that is consistent with the number of compounding times. So effective interest rate, we said effective interest rate, we said is equals to 1 plus, this was R over M power M minus 1. That is what we said. That is how we compute the effective interest rate. That is how we compute the effective interest rate, unless I'm getting the formula wrong, but that must be correct. 1 plus R over M power M minus 1 minus 1. So we compute the effective interest rate for each option, and we start with the post office MIS. Post office MIS, where the nominal rate is what we call in RR, 8% per annum. M is 1. Here M is 1. Because if it's the interest rate is per annum, or it's monthly interest rate, monthly, they're saying post office MIS scheme monthly interest. So M is 12. M is 12. M represents the number of times interest is compounded in a year. The number of times interest is compounded in a year is what you are calling M. And in this case, they are compounding monthly. So M is 12. So then the effective interest rate is equals to 1 plus 0.08 over 12 power M 12 minus 1. So get the interest rate here. Get the effective interest rate. Then we will go to ICD bank deposit. Let's first write, then we'll compute. Let's first have this, then we will compute. ICD bank deposit, they're saying quarterly interest. So our nominal rate is 8.25% per annum. M, the number of times compounding occurs in a year, it is quarterly, so 4. then effective interest rate is equals to 1 plus 0.0825, you divide by 4, then power 4 minus 1 is equals to, and the last one is HDFC Limited. HDFC Limited. Here the nominal rate is 8.5% per annum and half yearly. So here compounding occurs semi-annually, so it must be 2 times in a year. Effective interest rate is equals to 1 plus 0.085 over 2 power 2 minus 1. So now let's compute now. Let's compute. Get me the answer for the first one. Kindly save time, save on time. I've said I want us to do away with this topic today. And we have a lot to cover. %8.29%. Okay, whatever answer you are getting, multiply by 100 to get it in percentage. So now the answers are too many here. So for this is 8 point. Oh, that's okay. That's okay. 8.29, 8.3 is okay. Otito, yours is for which one? Because yours is a bit different. ICD. Okay. 8.51. Let's have the answers in 2 decimal places. 8.51. 8.51. Then the other side, HDFC, 8.68. 8.68. 8.68. So I believe that is okay with everyone. A vote that is for 8.5, or that is for this one. Okay, fine. Okay, thank you, Abod. That is it for that question. Unless someone has been left behind, we go to another question. Any question before we proceed? Oh yeah, we are supposed to advise. We are supposed to advise because the question says, using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option. The preferred investment option is the one that provides the highest effective interest rate. So which should be this one, HDFC Limited. So say the preferred investment option, advising the preferred investment option. The preferred investment option is HDFC Limited. Is HDFC Limited, since HDFC Limited, since it has the highest, effective interest rate. since it has the highest effective interest rate. It has the highest effective interest rate. Full stop. Then August 2023 question 5B. August 2023 question 5B. And I said, make sure you get the concept. Don't just compute, don't just write. Ensure you understand the question. And one thing, these financial management questions, if you want to get the concept and if you want to survive in financial management, number one, make sure you understand the question. Read the question and understand. Make sure that you can explain the story in that question, so that when you are doing the question, you're just converting whatever you've understood into writing. So like in this question, we're saying August 2023. Question 5B. August 2023 question 5B. That question reads, it's 5B. Joel Ouma needs shillings 5 million in 5 years' time to purchase a house. So this man wants to have 5 million shillings 5 years to come to purchase a house. Then he is determined to deposit a given amount of money each quarter in a sinking fund that earns interest at the rate of 12% compounded quarterly for 5 years. For 5 years. Required, compute the amount of money that Joel Ouma should deposit in each quarter in a sinking fund so as to enable him realize shillings 9 million in 5 years' time. And you can see that question is 5 marks. Very short, but 5 marks. Now, so let's start. Okay, this is now where understanding the question is coming in. You must understand what the question says, what it requires, so that you can know what to do. Now, in this case, you've been given the future value is 9 million. Say future value here. This is the money this person wants after 5 years. So then N is 5 years. Because they're saying Joel Ouma needs shillings 9 million in 5 years' time to purchase a house. He's determined to deposit a given amount of money each quarter. So he's depositing each quarter. So the number of times he's depositing money in a year is 4. Because a year has 4 quarters. So he's depositing 4 times in a year. In a sinking fund that earns interest at the rate of 12%, the interest rate is 12%, but compounded quarterly, at an interest rate that's, so they're saying he is determined to deposit a given amount of money for each quarter in a sinking fund that earns interest at a rate of 12% compounded quarterly for 5 years. For 5 years. So now the question is, compute the amount of money that Joel Ouma should deposit in each quarter in a sinking fund so as to enable him realize 9 million in 5 years' time. In 5 years' time. The amount of money that he should be depositing in each quarter in order to make it at 9 million after a period of 5 years. So here we have 2 methods. We can start by computing the effective interest rate. So, but before that, this is the future value. And we're looking for an annuity. We've just said that future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. That is what we've said. So the annuity, this is what we are looking for, because the annuity is the amount of money that he will be depositing each quarter. Then the future value of the annuity is the 9 million. So here you can say 9 million. This is the 9 million will come here. This is what we are looking for. How much should he be depositing to make it 9 million after that period of time? We will start with the effective interest rate method. Effective interest rate method. Whereby we are supposed to adjust the interest rates to reflect quarterly. This interest rate here, this 12% we said we are calling it the nominal interest rate. We said the nominal interest rate is given on annual basis. It is per annum. It is for 1 year, one financial year, or not just annual. It's an annual rate. So, but here, the compounding is done quarterly. That means you're supposed to adjust this interest rate of 12% per annum to reflect quarterly compounding. So here you can just say per annum. So we will start with this. Effective interest rate you're saying is 1 plus R over M power M minus 1. And I said, always in financial management, whenever you're doing a question, write the formulas. Write the formula. Even if you know it, just write the formula. It will even direct you on what to do. Like this one now, it will direct you. You will know this is 9 million. This is what I don't have. The rest I have. So here you'll say effective interest rate is 1 plus 0.12 over 4 power 4 minus 1. So get the effective interest rate. Get the effective interest rate. 12.55. 12.55%. Now this is what we are going to apply as our R. So we'll say future value. Oh, no, we are not repeating that again. We will say present value. Is it present value? No, future value is 9 million is equals to annuity. Annuity is what we don't know, times 1 plus 0.1255 power 5 minus 1 over 0.1255. So first get this factor. Get this factor in 4 decimal places. This factor should be in 4 decimal places. So annuity will be 9 million. You divide by the factor that you're getting here. Uh-huh, 6.4226. So please get me the amount here. Divide, you get me this amount. $140. This figure is too big, my friend. This is 1 million, eh? Someone else, kindly. Okay, fine. Let's see, something must be wrong somewhere. This one is for 5 years. Just a minute, we will see, we will compare. We will see where we are going wrong, if at all we are going wrong. We said we have two methods of this, eh? We said we have two methods of doing the multi-period. Remember, we called it multi-period compounding. Multi-period compounding. So just leave this the way it is. We will come back to this. I will check where the issue could be. Now we have this. We said, number one, you can adjust the number of periods. You adjust the number of periods, and again, you adjust the discount rates, and then you do the compounding. So method number two, this is number two. Just say or say number of periods will be 5 times M, 20 years. We will get 20 years there. Then discount rates. Discount rate, we said, sorry. This one should be, so I just wanted to say N times M, which is 5 times 4. You get 20 years. Then discount rates will be R over 2, not 2, but M, R over M. So 12% divided by 4, we will get 3%. So we are saying, instead of using the effective interest rate method, we have another option. Of adjusting the number of periods, because you're saying, if this person is going to save for a period of 5 years, and each year he is saving 4 times. So the number of periods will increase. So it's like saying, we have a period here. This is 0, this is 1, this is 2, this is 3, this is 4, and this is 5. So these are 5 periods. 1, 2, 3, 4, 5. 5 years. But you're saying in each year is making 4 payments. So there are other periods here. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. 1, 2, 3. So these are not the period, because compounding is occurring quarterly. We are supposed to count this. 1, 2, 3, 4, 5, 6, 7. They will be 20. Then the interest rate that we have is for 1 year, 12%. But we are only compounding for quarterly for 3 months. So you divide by 4, you get 3, 3, 3, 3, which must add up to 12. That's why we're saying R over M, we're getting 3%. So with that now, we can apply this formula. We say annuity, which is 9 million. is equals to annuity times 1 plus 0.03 power 20 minus 1 over 0.03. So then now you say annuity is equals to 9 million over the factor that you'll get there. Let's have in 4 decimal places. Anna, in 4 decimal places. So you get in 33. Three 34, 941. So this is 26. It said 26, 26.87, 26.8704, 8704, 26.8704. Then here the annuity, you're saying shillings, 334, 941. 334, 941.05. So that should be the correct answer. That should be the correct answer. So that means here, we are supposed to adjust the periods again here. This one, this effective interest rate, we adjust. We adjusted to, like we've adjusted there. So it is the same thing. So here the number of periods will change. So here we are supposed to say divide by, just a minute. You divide this by 4. So this will become 20. Then you divide by 0.1255, you divide by 4. So that is where the issue was. After getting the effective interest rates, you will still again adjust the number of periods. So get that. Just check now. Check now. Okay, it will not be the same, but almost the same. Rounded off. Check whether you're getting the same. Enad, are you getting the same answer? Hi, 330. 330 is a bit low. If you divide 12.55 over 4, then you use 20 here. The same case here. This is becoming almost the same, 3 point something, 27.39. Or 332.82.81. 338.82.81. So I would advise we go with this. This will not complicate issues. This will give us the exact figure, this method. Because here we've adjusted the number of periods, we have adjusted the discount rate, we are getting full numbers, or rather whole numbers. Then we apply the formula, we get this. So this is okay. Let's go with this. Let's go with this. This is more accurate. That is more accurate. That's more accurate. Now, do we need to do another one? Let me see. April 2020, April 2023, question 5D. Let me see whether it's April 2023. If it's similar to what we've done, we're just going to proceed. So they're saying John Osoro has deposited 7 million into a savings account at an annual interest rate of 5% compounded, with additional deposits of 10 per month made at the end of each month. So this is a bit different. I've advised we go with this, Martin. I've advised we go with this method of adjusting the number of periods and adjusting the discount rates. This one will not mislead you. So let's have April 2023 question 5D. April 2023 question 5D. Question 5D. April 2023 question 5D. Now, John Osoro, that question for John Osoro. That question for John Osoro is what you're looking at. The question says, John Osoro has deposited shilling 700,000 into a savings account at an annual interest rate of 5%, compounded monthly. So John Osoro has deposited 700,000 into a savings account at an annual interest rate of 5%, compounded monthly, with additional deposits of shillings 10,000 per month made at the end of each month. Required, determine the value of the investment after 10 years. Determine the value of the investment after 10 years. So here we have a lump sum. We have a lump sum of 700,000, and we have annuities of 10,000 per month. And this will be done for a period of 10 years. So you need to get the present value of each separately. So here we have a lump sum. We have a lump sum of 7 million. We are saying shillings 700,000, sorry. 700,000. So initially he deposits 700,000 shillings into a savings account at an interest rate of 5% per 5% compounded. This is per annum at an annual interest rate, 5% per annum, but compounded monthly. M is 12. M is 12. The number of times compounding is occurring in a year is 12. Then compounded monthly with additional deposits of shillings 10,000 per month. Annuity. There is an annuity here. Shillings 10,000 per month. 10,000 per month. So what I'm saying, how we are going to get the present value of this lump sum is different from how we are going to get the present value of this annuity figure. Because here the question says, determine the value of the investment after 10 years. So here is saying value of investment. Value of investment is equals to present value of the lump sum. No, after 10 years. Determine the value of the investment after 10 years. So value of the investment is equals to future value of the lump sum, future value of the lump sum, plus future value of the annuity, plus future value of the annuity, future value of the annuity. Now, we need to adjust this here. Let's start by adjusting the number of periods. Number of periods, we have said, number of periods is equals to n. Where is n here? We don't have n. N is 10 years. N is 10 years. Number of periods is n times m. So n, 10 times what? 12. We get 120. So the number of periods is 120. Then the discount rate or the interest rate, we can just also call it the interest rate. The interest rate is R over M. 5% divided by 12. 5% divided by 12 because compounding is occurring. Compounding is being done monthly. So get the interest rate, that is consistent with compounding period. 5/12 is what? Five over 12. No, but this one, yeah, let's have it the way it is. 5, if you divide by 12, I'm getting 0.42. Let's say 0.42%. 0.242. Don't forget this is percent, because we are going to divide further by 100. We're going to divide further by 100. So we start with the future value of the lump sum. Future value of lump sum is equals to the lump sum is equals to the lump sum, or let's say future value of a lump sum is equals to present value 1 plus R power N. So this one will be 700,000 is equals to, or rather times 1 plus our R is now the adjusted one, 0.42 over 100 power the periods 120 power 120. That will give us the present value of the lump sum. That will give us the present value of the lump sum. Then future value of the lump annuity. Future value of annuity. Future value of annuity is equals to the annuity times 1 plus R power N minus 1 over R. Again, for R and N, we are going to use their adjusted values. We are going to use the adjusted values. So our annuity is 10,000. 10,000 is what we are saving monthly. So times 1 plus 0.2, 0.42 over 100 power 120 minus 1 over 0.42 over 100. So here we will get the future value of the annuity. So remember, the reason we are just dividing by 100 because we want to convert this percentage to numbers. We are converting the percentage to numbers. So basically, the 100 has no other reason to be there, because you can just say 0.0042 and you'll be good to go. So the first one I'm getting 1157,508. I don't know what you're getting. 1157,508. 1157,508. Confirm whether you're getting the same. 1157,508. Yeah, that's okay. Let's have the present value of the annuity now. So this one is 1 plus 0.0042. Close the brackets, power 120 minus 1 divide by 0.0042 times 10,000 times 10,000. I'm getting 1556 150. 1556 150.42. I believe you're getting the same. 1556 150.42 for the annuity, for the future value of the annuity. Then now you add value of investment, is equals to 1157,508 plus 1556,150. Ignore the points. So this is 2,713,658, 2.7, 271, 39.59. Bernard, why is mine different from yours? Who is right, who is wrong? 1157,508 plus 2713,658. Okay, fine. Mine seems to be okay. So that is how you do time value of money questions. Like I've said, here there is no format.
A decrease of 800. A decrease of 800 from 72 to 64. Yes. So then from there we have machine. Machine, its carrying amount is how much? The carrying amount for machine is 28. It will be revalued to 2,000. So we have a decrease of 800. We have a decrease of 800. And then buildings, it will be revalued to 5,000. From 6,000, we equally have a decrease of what? Of 1,000. A decrease of what? Of 1,000. Sasa, yes, in that case, I've said both depreciations which are given there, we ignore them. I've said you cannot revalue an asset today and you depreciate the asset at the same time. So you revalue, then depreciate the asset at the end of the year. So therefore, we ignore those depreciations. So basically, it means that the value for all those assets, receivables, inventory, machine, building, the value reduces. How do we account for that decrease in the value of the asset? We said once the assets have been revalued and their value reduces, we need to credit the specific asset account in order to reduce its value. We complete the double entry by debiting the account called the capital reduction account. So therefore, the first general entry here is basically to account for the revaluation of those assets. So if you check those values, they are basically in thousands of shillings. Okay, so when making the general entry, let's have the debit column here and basically the credit column. So we always start with the account to be debited. That's basically what we know. The account to be debited is the capital reduction account. And this account will be debited with the total decrease, or actually with the total decrease in value for all the assets. We have 400, 800, 800, and 1,000. That will give us a total decrease of how much? That should be 12, 2,000, 3,000. Are you getting a total decrease in the value of assets to be 3,000? To be 3,000. We try to hurry because of time, yes. So then we debit that account, capital reduction account, and then we credit a number of assets. Which account are we crediting? First of all, we credit the receivables account. The receivables account is an amount of 400. We also credit the inventory account. The inventories account is an amount of 800. We credit the machinery account with an amount of 800. We also credit the buildings account. The buildings account with an amount of what? With an amount of 1,000. With an amount of what? of 1,000. And then in this case, we said, make sure you give a brief narration. The narration will be being a revaluation of assets. Being a revaluation of who? Of assets. Being a revaluation of assets. So we have accounted for the revaluation of assets. Let's move to note number 2. In note number 2, we are told its ordinary share is to be redesignated as a share of 2.5. And then you're told the ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares held at a price of 4. Now, 2 things there. Number 1, we need to account for the decrease in the value of the assets, because we are told the shareholders will accept a decrease in the value of the share from 10 shillings all the way to 2.5. In this case, what we need to account for here is the amount of share capital, which automatically was written off. So the amount of share capital written off, first of all, we determine the amount which was written off per share. If the company is reducing the par value of the share from 10 to 2.5, it basically means that part of the par value has been written off. The amount written off is that decrease. So the value of the share is reducing with how much? Is reducing from 10 to 2.5. The value of the share, therefore, is reducing with 7.5. We multiply that with the shares issued by this company. And in this case, I hope you can see that information deals, note number 2 deals with the ordinary shares. So we go back to the balance sheet of this company, specifically at the equity. That's where we get the shares issued. So how many shares were issued by this company? We take the equity share capital or the ordinary share capital, which is 20,000. Remember, these are not shares. This is the share capital. How do we get the number of shares? We divide that with the par value, which is still in the balance sheet at the equity. I hope you can see the word equity shares of shillings 10 par value. So therefore, the shares issued by this company are 2,000. We multiply that with 7.5. And that basically will give us what? That will give us what? Will that give us 15,000? 15,000, the amount of share capital which is written off. The amount of share capital which is written off. Yes. So how do we account for that? How do we account for this? Remember, we say, in case we want to reduce the share capital, remember share capital has a credit balance. So if we want to reduce this, we debit that account. We debit share capital. We complete the double entry using the capital reduction account. So therefore, in this case, we will debit the equity share capital account. Equity share capital account with the amount which was written off, 15,000. And then we complete the double entry by crediting the capital reduction account with the same amount of 15,000. The same amount of 15,000. What is our narration here? Our narration is being the share capital, which is written off. So what we have accounted for here is the share capital which is written off, being the share capital written off, being the share capital written off. So in the same point, number two, we are told, other than the company writing off the value of each share, we are told the existing shareholders of the company will subscribe. To subscribe is to buy. If you buy shares of the company, you pay for those shares. So in this case, we are told they have to subscribe. They have to buy a new or basically new shares on the basis of 1 share. So these are the new shares to be issued. New shares to be issued. And basically I've said that these are shares to be issued in cash. The existing shareholders will buy some shares. So they are to subscribe new shares on the basis of 1 share, on the basis of 1 share for every what? For every 2 shares which are held, for every 2 shares which are held. Now, how many ordinary shares are currently held? From what you have done up here, how many shares are currently held by the existing shareholders? The shares currently held, yes, we have said are 2,000. So these are the shares which are currently held. So we just cross multiply, then we divide, so that we determine how many shares are currently held. Sorry, how many shares will be issued, not held. So the shares to be issued will be 1 times 2,000 divided by 2, and basically this will give us 1,000 shares. 1,000 shares, and then we are told each share will be issued at 4 bob. Each share will be issued at an amount of 4 shillings. So meaning that the amount of money the company received here would be 4,000. So how do we account for this particular amount received by the company? How do we account for that amount received? Number 1, because this money was received the shareholders paid for that money. We debit the bank account. Remember this money received. We debit bank, and then the company issued shares. So we credit the equity share capital account. Remember, the amount credited to be credited in this account always has to be based on the par value. Now, what is the new par value per share? What is the new par value per share here? What is the new par value per share? The new par value per share, Ningapi. The new par value per share is 2.5. Remember, it was previously 10. It has been reduced to 2.5. So therefore, the amount to be credited in this account will be based on the par value 2.5 times the shares issued. The shares issued were 1,000. So the amount credited in this account is 2.5. Now, it automatically means that because the shares were issued at 4 bob, the shares were issued at a premium, at a share premium. We said whenever we are accounting for external reconstruction and shares have been issued at a share premium, that share premium is not taken to the share premium account, but rather we credit it in the capital reduction account. Sasa, yes, that amount we will not credit it in the share premium account, but basically we credit it in which account? The capital reduction account. And automatically that should be the difference here. That should be the difference 15. So we give a brief narration being issue of additional shares, or maybe being issue of shares for cash. So we are done with that. Let's move to point number 3. We are told the existing preference shareholders are to be exchanged for a new issue of 6 million, 15% preference shares of shillings 10 each, and 800,000 ordinary shares of shillings 2.5. So it basically means that if we go back to the balance sheet of this company, specifically at the equity, you'll see this company had issued 12%, not 12%, rather 10% preference shares. So the preference shares issued by this company, they have a value of 8,000. So we are told the holders of these particular shares will be required to surrender them back to the company. In exchange of what? In exchange of 6 million. In exchange of 6 million. 6 million preference shares. Preference shares having a value of 10. And 800,000 ordinary shares. 800 ordinary shares. Each share having a value of 2.5. 2.5. Yes, and I think usually this question there is a small typing error. So this particular amount here, you see this amount here, 6 million. That's 6 million. That should be shillings, because you can see that these preference shares currently issued by the company, they have a value of 8 million. So automatically, once they are required to surrender them back to the company, they are required to surrender these shares back to the company. They must be issued with other shares or even debentures having the same value, having the same value. So if you take 6 million times 10, because you can see, take into account we don't have the word shillings before 6 million. We can only take 6 million to be the shares. So you should take the share 6 million times 10. That will give us 60 million. You can see that one is more than that. So that's why I'm saying there was a small typing error. This one should be shillings. If you have the physical paper, so before the word 6 million, we should have 6 million. The issue of 6 million, 15% preference shares of shillings 10, and 800,000 2.5, or ordinary shares of 2.5, such that if you work out this now, you work out this 6 million, and then these ordinary shares which were issued 800 times 2.5. So if you multiply these two, this will give us what? Is it 2,000? 800,000 times 2.5. Is it 2,000? Yes, it should be 2,000. Such that if you add this and that should give us 8,000. So these preference shares which were issued and these ordinary shares which were issued, they must be having the same value, because the old preference shares which have been issued are to be exchanged with the new shares. Yes, so that's why I've said there was a small typing error as far as that question is concerned. Now, what we need to do here is, number one, we cancel these shares. We cancel these shares. How do we cancel them? We cancel them. Remember, this account has a credit balance. So to cancel this, we will debit this account, and then we go ahead and basically debit to account. We debit this account for the new preference shares which were issued, and also we credit. That is to credit that account, and also we credit ordinary share capital. So we debit the 10% preference share capital, and then we credit to account. So we are cancelling the old shares and accounting for the new shares which were issued. So we debit the 10% preference share capital account with an amount of 8 million, or basically 8,000, and then we credit these preference shares which were issued. They were 15%. We credit 15% preference shares, preference share capital account with 6 million, and then we credit equity share capital with an amount of 2,000. With an amount of 2,000. Yes. So what is the narration? Being the old preference shares which were cancelled. Being the old preference shares which were cancelled. Yes, and I think we are done with that particular point. Let's move to point number 4. In point number 4, what are we told? We are told that the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 each in lieu of interest payable. Then you're told the 12% debentures are to be converted to 14% debentures. And then you're told a further shillings 2 million or 14% debentures of shillings 10 each are to be issued and taken up by the existing debenture holders at 90 shillings per debenture. So in that case, I think we have like 3 transactions we need to account for. Number 1, let's account for what we have in the first sentence. We are told the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. It basically means that the interest which was supposed to be paid to the debenture holders was in arrears. So instead of the debenture holders being paid that interest which was in arrears, instead of being paid that interest in cash, they will be issued with the ordinary share of the company as a form of a payment. So first of all, we need to determine how much was this interest, or how much was the interest in arrears. That one is in the balance sheet of the company below paragraph 1 and specifically under equity. Can you be able to see the interest payable on debentures, or the interest payable to the debenture holders under equity? Under equity, yeah, that one should be 720, not 2,000. Should be 720. So basically, what we need to do, remember that is a liability. So being a liability, we are told this amount automatically will be paid. How will it be paid? It will be paid by the company issuing shares. So we need to first of all cross off this account. Because the liability has a credit balance, how do we cross that account? We debit that account. So the journal entry number 5 is to debit that account. We debit the account called interest payable on debentures with an amount of how much? 720. And then the debenture holders here will be paid by being issued with the shares. So how many shares will be issued to the debenture holders? The debenture holders in that case, we are told as per note number 4, they will be issued with 200,000 ordinary shares over 2.5. Of 2.5. Automatically, if you multiply these two, that one will give us 500,000. 500,000. So what happens, or what is the difference now here? You can see the amount which was to be paid 720, but the shares issued, they had a par value of 500. What happens to the difference? And remember, the amount to be debited has to be equal to the amount to be credited. Yes, the difference is the share premium. Do we take it to the share premium account? No. So we have said any share premium, any shares which are issued as a premium, any share premium is taken to the capital reduction account. So the difference here, which is 220, is the share premium. But do we credit it in the share premium account? No. We credit it in the account called the capital reduction account. Capital reduction account. So we can say in the narration, being payment of accrued interest. Being payment of accrued interest. So still in the same point, we are basically done with that. Still in the same point, sentence 2, we are told that the 12% debentures are to be converted to 14% debentures, just like what you have done here. So what we need to do is we need to cross off the 12% debentures account. If we go back to the balance sheet of the company here and the equity, you'll be able to see that our company had issued 12% debentures. 12% debentures. We are given their value. We know debentures is a liability. So this account should have a credit balance. So these debentures are to be exchanged, to be converted, that is, to 14% debentures. What does that mean? It basically means that we need to cross off that account by debiting it, and then we open another account called 14% debentures. So this account, we credit it with the same amount. So we debit the 12% debentures basically to cross off that account, and then we credit the 14% debentures account. So what is the value of these 12% debentures from the balance sheet of our company? The 12% debentures, they had a value of 6,000. So in other terms, we have converted the 12% debentures into 14% debentures. So narration, being conversion of 12% debentures into 14% debentures. Being conversion of debentures, or you can just put it like that. Remember that narration has no mark, but it's always good to give a narration of what you have accounted for. Sasa, yes. In the same point, we also have other debentures which were issued in cash. In the last sentence, a further shillings 2 million 14% debentures of shillings 100 are to be issued and taken up by the existing debenture holders at 90 bob. So these are new debentures to be issued. The 14% debentures, we are told having a value of 2 million, having a value of 2 million, but in this case, we are told their par value is 100, but basically they will be issued at a discount. They'll be issued at a discount because we are told they will be issued at 90 bob. So basically what that means is that our company here, instead of receiving 2 million, the cash to be received, the cash received will be what? Will be 90 all over 100 times what? Times 2 million. In other terms, because they have a value of 100, but they will be issued at 90, it's like they were issued at a discount of 10%. Sasa? Yes. So the amount to be received should be equal to what? Should be equal to 90%. Because they were issued at a discount of 10, the company received 90% of 2 million, which is 1.8. 1.8. So that is basically the amount to be received. How do we account for this amount received? The amount received, number one, this one will be debited in the bank account. We debit the bank 18 with the cash which was received. With the cash which was received. Now, the difference which is, or actually the discount, which is 200,000, which is the discount, that one, basically we take it to which account? We take it to the capital reduction account. We must account for that discount. So that discount is 200,000. We take it to the capital reduction account because by the end of the day, the amount to be credited in this account, the amount to be credited in the 14% debentures, 14% debentures, just like what you have said in relation to the shares, that one has to be based on the par value. Remember, the par value is 100. So the amount to be credited in this account has to be based on the par value of 100. So meaning that the amount to be credited in this account should be 2,000. It has to be based on the par value, just like the shares, So the narration being an issue of debentures for what? For cash. Being issue of debentures for cash. We are basically done with that. So let's move to the other point, number 5. In note number 5, we are told shillings 800,000 of the loan from directors is cancelled, and then you're told the balance of the loan is to be settled by the issue of 200,000 shares of shillings 2.5. So first of all, can we go back to the balance sheet of this company? We check how much was the loan from the directors. The loan from directors, that has to be either below as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this shillings 800,000 will be cancelled. In other terms, it will be written off, whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debit it with the total amount, because the full amount will be written off. Will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? And that amount which was written off will be credited in the account called the capital reduction. This is the amount which was written off, the loan which was written off. It will basically be debited here, credited in which account? Capital reduction. Then this amount which was paid through the issue of shares, I hope you can see the number of shares which were to be issued to the directors. The directors were to be issued with how many shares? Are we given the number of shares which were to be issued to the directors? Yes, the directors were to be issued with 200,000 shares. 200,000 shares, each share having a value of 2.5. So if you multiply these 200 times that basically will give us 500. But you can see the amount which was to be paid by the company through the issue of shares, Ningapi, the amount which was to be paid through the issue of shares was 1,200. It also means that these particular shares which were issued to the directors were issued at a premium. Is that the position? Are they issued at a premium? Yes, because you can see the amount which was to be paid was 12, but the par value of those shares is 500. So therefore, what will be the double entry for that? We will credit the equity share capital with the shares which were issued, which are 200 times 2.5. 2.5, basically that will give us 500. So the difference between 500 and 12 will be a share premium. Where do we take the share premium? To the capital reduction account. To the capital reduction account. Remember, that is the share premium. That is the sharehood, the share premium on the shares which were issued. So by the end of the day, if you add this, the amount to be credited, the amount to be what? The amount which has been debited, you'll be able to see the amount is the same. So 800 plus the 500, which is 13, plus 700, 2,000, which is equal to that. So this is our narration being director's loan, which was cancelled, director's loan cancelled and paid. So we have accounted for the director's loan which was cancelled and the one which was paid. We are basically done with that. So then let's move to the other point, number 6, and I hope you're together up to that point. I hope you're together up to that point. Are we together up to that point? Can we move to point number 6? Yes, we are together up to that point. So in point number 6, you're told the investment are to be sold at their current market value of 6 million. So which are these particular investment? Investment automatically should be an asset. So if we go back to the balance sheet of this company, below the non-current assets, I can see we have intangible assets. One of the intangible assets is investment. The value for investment is 45. So we are told that investment, as per note number 6, we are told that investment will be sold at the current market value of 6 million. So the investment will be sold at a profit, because if you take the carrying amount of that investment is 45, but the investment will be sold at 6,000. So that profit, that gain on the sale of investment, that one automatically we cross it off, we take it to the capital reduction account. So first of all, we account for the amount which was received. The amount received, that one is debited in the bank. So how much amount was received? It should be equal to the sales proceeds. Sales proceeds is what we have in note number 6. Our investment was sold at 6 million. That is what we debit in the bank. That is what we debit in the bank. And then the amount which we credit in the investment account should be equal to the carrying amount. Investment was recorded at 4.5. We credit that account with 4.5. The difference, which is basically 15, we are saying is the gain on the sale of investment. So that gain on sale of investment, where do we take it? We take it to the capital reduction account. To the capital reduction what? Account. So the narration here is being what? Being investment sold. Being investment which was sold. Being investment which was sold. Being investment which was sold. We are basically done with that. Let's move to point number 7. You're told bank overdraft was paid in full. Also very simple. Bank overdraft, we know, is a liability. Is a liability. So if bank overdraft was paid and is a liability, we need to cross off this account by debiting that. We debit that account, we credit bank account. So we debit bank overdraft account. Bank overdraft, this one has to be part of the current liabilities in our balance sheet. And the bank overdraft is basically 3,000. And then we credit bank account with an amount of 3,000. So the narration here is being payment of bank OD. 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 Yes, so we are done with that point. Let's move to point number 8. And we are told the sum of 3.18 million is to be paid off, to offset the sundry payables immediately, and the balance in 4 equal installments at the end of each quarter. So I think in our case here, what we need to do is to account for the amount of payables which was paid, or the amount of sundry payables which was paid. So that one is basically quite simple, because what you just need to do is to, once a liability has been paid, we debit the liability account. So we will debit the payables account, or actually the sundry payables, which is basically part of the current liabilities. Sundry payables with the amount which was paid as per note number 8, that 180, and then automatically we do what? We credit bank. We credit bank. I hope you can be able to see down there. That 180. That 180. That 180. Then we need to give a brief narration for that. We need to give a brief narration for that. A brief narration for that. So being payment, or being partial payment, to who? To creditors. Being partial payment to creditors. Yes. So we are done with that, basically. And then we are told the balance will be paid in 4 equal installments. Are we interested with the amount to be paid in the remaining amount to be paid? No, because if you check on what you're told in part B, we are required to prepare the balance sheet of this company immediately after effecting this. So not even after a quarter, not even after a day, immediately after the company effected this. So we are not interested with the amount to be paid in those quarters. Yes, we are not interested with that. Then number 9, we are told all intangible assets are to be eliminated. Being eliminated means that all the intangible assets will be written off. Will be written what? Will be written off. So I need to create some space here. Yes, so all the intangible assets will be written off. Which are those intangible assets? Automatically, it is all the intangible assets excluding investment. Remember, investment was sold. So we need to write off goodwill and patent and trademark. So how do we write off assets? So basically, we credit the asset account, because assets have a debit balance. We credit the asset account. We debit the capital reduction. We debit the capital what? The capital reduction. So this should be journal entry number 12. We debit capital reduction account. Capital reduction account with the total value for the 2 assets. Goodwill, 6,000. patent and trademark 500. That will give us a total of 65. And then which account do we credit? We credit goodwill with an amount of 6,000. We credit patents and trademarks with an amount of what? With an amount of 500. Narration being intangible assets, which were written off, or maybe which were eliminated. Being intangible assets which were written off, or being intangible assets which were eliminated. Yes. So we are done with that. Then note number 10, we are told it is estimated that under the new arrangement, yes, now that information which we have in note number 10, that one will be used in answering part C. Do we use that in making the journal entries? No. That one will be used in answering part C of the question. So we are basically done, but there is something here we must always remember to account for, even if that information is not provided by the examiner. Remember, this company is trying to clean its books of accounts. Whenever the company is doing internal reconstruction, the company has to write off any accumulated losses. Even if that information is not given to you by the examiner, you must remember to account for that. You must write off the accumulated losses. So if you go back to the balance sheet of our company, specifically at the equity, you'll be able to see that the company had accumulated losses of 5.8. That accumulated losses has to be written off because the company cannot do internal restructuring and still the books of account remain with accumulated losses. That has to be written off. So how do we write off these accumulated losses? So remember, this account always has a debit balance. It is the retained earnings account which has a debit balance because those are losses. How do we write off that account? We credit it and then we debit the capital. We debit the capital reduction. We debit capital reduction account with accumulated losses of 58. And then we do what? We credit. We basically credit the accumulated losses account. Accumulated losses account with the 58. So what is the narration here? Narration is being accumulated losses. Being accumulated losses which were written off. Being accumulated losses which were written off. And I think in our case, basically we have done with preparing what was required. So in part A, that basically what was required. So by doing this, the marks are located here. Are basically what? Are basically 10. In most of the cases, you'll see that the marks are located here is half for every correct entry, half. So it basically means that you needed like 10 items, not 10 other, 20 items, 20 correct entries here. And basically you get the 10 allocated what? 10 allocated marks. Now, if you can be able to recall the other question which we did in class, after this, the examiner basically was requiring us to prepare the capital reduction account. Even though it is not a requirement in this question, can we prepare the capital reduction account? Let's prepare the capital reduction account, even though it is not a requirement here. Even though it is not what? A requirement. So let's prepare that account. I want to create some space here. So, but basically we have to remember here, our capital reduction will be debited with a total of 3,000. Yes. So let me create some space here. So we prepare the capital reduction account. Capital reduction. Capital reduction account. Capital reduction account. Yes. So, and our figures are in thousands of shillings. Are in thousands of shillings like that. Yes. So we have said as per the first journal entry, basically we said you need to go through all your journal entries, journal entry number 1 up to journal entry number 13 as you check what is affecting the capital reduction. Journal entry number 1, our capital reduction account is to be debited. Is to be debited with various items. So the first entry comes from the account called the trade receivables with an amount of 400. The other entry is in the inventories account with an amount of 800. The other entry is in machinery account with an amount of 800. And basically the other entry is in buildings account with an amount of how much? With an amount of 1,000. So that those particular amounts are basically what? Are debited in this account and then credited in the respective account. in the respective what? In the respective account. In the respective what? Account. Then we go to the journal entry number 2. We check whether the capital reduction account is affected. Yes, capital reduction account, you can see, it's supposed to be credited. The other entry, so this account we credit this. So the other entry is in equity share capital account with this particular amount, 15,000. Journal entry number 3 is the capital reduction account affected. Yes, capital reduction account is to be credited with 15. So the other entry is in bank. That also affects capital reduction. Does this affect the capital reduction? No. Journal entry number 5 is the capital reduction being affected. Yes, capital reduction account is to be credited. The debit entry is in the interest payable on debentures, which is 220. So then this journal entry capital reduction is not affected. Here capital reduction is to be debited. The other entry is this account is to be debited. The other entry is in 14% debentures with an amount of 200. I can do away with this basically. Yes, so then from there we have the other journal entry here. This one. So the capital reduction account will be actually credited with a total amount of 800 and basically 700. I think we can combine that here. So that will be a total of 1,500 to be credited. This account will be credited. The other entry is in the account called loans from directors with a total of 1,500. That plus that, which will give us 15. So then from there, journal entry number 9. So the capital reduction account is supposed to be credited with 1,500. So the other entry is in bank account. Journal entry number 10. Journal entry number 10 here. Capital reduction account is not affected. Journal entry number 11. Capital reduction is not affected. Journal entry number 12. Capital reduction is supposed to be debited. One of the entry is in goodwill account with an amount of 6,000. The other one is in patent and basically trademark 500. And then finally, journal entry number 13, capital reduction account will be debited with an amount of 58. So the other entry is in the account called what? The accumulated losses account. And basically we are done. So remember, you say that this account should either automatically balance or should either balance of all. We have a balancing figure on this side, which is called the capital reserves. The account should either balance or basically we have a balancing figure on the debit side, which is known as the capital reserves. Yes, so can we do that? Can we determine whether account is balancing, or basically we have what? We have a debit balance. That is basically what I'm getting on the credit. Yes, that is basically the figure I'm getting. Yes, so that is also what I'm getting from Ismail. Is that what you have? A balancing figure on the debit side? A balancing figure on the debit side, which is called what? The capital reserve. Is that what you have? Is that what you have? I hope that is what you have. I hope that is what you have. I hope that is what you're getting. Yes. Yes. So basically that is it. What we need to do is we basically move and prepare what is required in part B. What is required in part B? What is required in part B? What is required in part B? In part B, I think maybe first of all I can give you a small breather, and then we come back having a lot of energy. We finish on what is remaining. So let's just take a small breather. We come back at 9:25. We continue. So a small breather, then we come back. Yes. So I want us to continue. Let's continue. Let's continue. I hope you're back. I hope you are back. Yes. So let's continue. I want us to go straight to preparing what is required in part B of the question. And basically, the examiner was requiring we prepare statements of financial position immediately after the internal reconstruction. Statement of financial position. This is as at 1st November 2021. 1st November 2021. So we just need to have a single column here, and we start with the non-current assets. So the non-current assets, we start with basically what you need to do when preparing this. You should be guided by the original statement for financial position. In the original statement of financial position, we have land, buildings, machinery, intangible assets. So number one, we know that land was not revalued. The value for land remained the same. Land was not revalued, and basically its value was 8,000. Then below that we have buildings. Buildings, we record the value which we have in note number one. Buildings. We have, someone is asking, we go back to the general entries. Let's first of all we finish this one. Then maybe I'll see. So buildings was basically valued as per note number one, and basically the value for buildings is 5,000. Is 5 what? 5,000. 5 what? 5,000. 5,000. Yes. So then still in our statement for financial position, below buildings we have machinery. So basically machinery was valued as per note number one, and the value for machinery is basically 2,000. 2,000. So then below machinery, I've said we are using the original statement for financial position. So below machinery, what do we have? Intangible assets. We know investment was sold. Will it appear here? No. We know goodwill and basically patent and trademark were written off. They will not still appear here. So mean that all those particular intangible assets will not appear there. So then from there, we move and basically record the current assets. So for current assets, we start with, basically we have two current assets. Actually three current assets in our statement of financial position. We have the first one, which is inventories. Inventories were valued as per note number one to an amount of 64. We record inventory here at 64. Then also we have receivables. Receivables were valued as per note number one to a value to an amount of 36. Still in our statement of financial position, we have cash. Cash, this will not change. Because all the other amounts which were received by the company, we have assumed they were received through bank, or any payment which was made by the company, we have assumed it was made through bank. Automatically here, we will have to prepare the bank account and basically determine what is the bank balance, because there is automatically money which remains in the bank balance. And actually, instead of preparing the account, we can have that working here directly, because we know what was received, what was paid. So I think we just need to go through general interest number one. There was no any amount there was nothing affecting bank in general entry number one. General entry number two, there were those particular shares which were issued for cash. The shares which were issued for cash, they had a value of how much? Just go to the shares which were issued for cash and you give me that amount. We try to hurry up because of time. Was it 4,000? Was it 4,000? 4,000? Yes, 4,000. 4,000. So this is basically money received. So we will take all the money received as positive, any payment as a negative. So we have that amount which was received as per note number 2, note number 3, no cash which was received. Note number 4, we have the amount which was received from the issue of debentures, and that amount was 1,800. The amount received from the issue of debentures, is it 1,800? Yes, 1,800. Amount received from the issue of debentures, as per note number 4, please confirm. I can remember it was 1,800, the amount received from the issue of debentures. Then from there we have note number 6, the investment which was sold at 6 million. So this is the cash received, 6,000. Then we have note number 7, we have payment of an overdraft, that is minus. The overdraft was 3,000. The overdraft was 3,000. Then we also have note number 8, the payment to the creditors, that 180, which is still a negative. That 180 is a payment. Yes, I don't think we have anything else. That should give us the bank balance. That should give us the bank balance. The bank balance, I hope that is the figure I'm getting from Patrice, of 5620. Because the total amount received should be 10,000 plus 18, that is 11,800 minus 6180. Yes, so that one should give us what? Should give us 5620. Yes, I don't think we have any other asset here. And basically, we say no need of even getting these totals. We say these totals are not marked. So just move and you record equity. So for equity, we will also be guided by our original statement for financial position. So first of all, we have equity share capital. Equity share capital. We know this equity share capital change. So the original share capital is basically 20. Instead of preparing the ledger account, let's just do the adjustment here. So then we go to the notes, and basically whatever is affecting share capital, we adjust it here. Ordinary share capital. So we have note number 1 is not affecting this. Note number 2, we have the amount of share capital which was written off. The share capital written off reduces this. So the share capital written off, I can remember, was 15,000. This is the share capital written off. We deduct it from 20,000. Then we also have the shares which were issued as per note number 1 in cash. And whatever we add here is the par value. Out of the shares which were issued for cash, the par value for those shares is 25. Is that the position? The amount credited in the share capital? For your case, you can check that from the journal entries. You can check that from the journal entries you have. You check what is affecting ordinary share capital. That's that? Yes. So if it is a debit, it is to deduct that amount here. If it is a credit, is to add. So then accounting or actually number 2, we have an amount of 15,000 written off, and the shares which were issued at 25. Then note number 3, we have the shares which were issued, whose value is 2,000. We add 2,000. We add 2,000. We add 2,000. So then journal entry number 4, do we have shares which were issued there? Yes, the shares which were issued in lieu of interest, and basically they were 2,200 times 2.5. Basically, which will give us what? 500. Yes, what about journal entry number 5? So we have the loan paid to the directors. Yes, we have the shares which were issued to the directors. The shares were 200 times 2.5, and I think that will also give us 500. I hope that is still correct. Yes, and then we have note number 6, 7, 8, 9. I don't think we have any other transaction affecting ordinary share capital. What should be the final figure for the ordinary share capital? That should be 575, 45, 55. Is that the position? Yes. So this is the 5,000, 75, 95, 10,000, 10,500. 10,500. Yes. So then from there we have this capital reserve. This capital reserve, we have it here as a component of reserve, capital reserve, which is basically an amount of 4220 capital reserves. Then we still go back to our original balance sheet and we check what else to be included here. We have 10% preference shares. Those 10% preference shares, I hope you can remember, they were cancelled as per the information we have in note number 3. They were exchanged with 15% preference share. So here we will have 15% preference shares, or basically 15% preference share capital. So the preference shares, as per note number 3, basically will be having a value of 6 million. A value of 6 million. Value of 6 million. 15% preference shares. Yes. So then from there we go back to our original balance sheet. We have debentures. I think those debentures we can now classify them as non-current liabilities. So then from there, still at the original balance sheet, we have interest payable on debentures. Will that appear here automatically? No, because I hope you can remember that amount was paid. The loan from directors will not appear here. It was part of it was written off, part of it was cancelled. The accumulated losses still will not appear here. So all those items will not appear here. So then from there we can move and basically we record non-current liabilities. Now for the non-current liabilities, we will have debentures, but I hope equally you can also be able to recall those debentures, 12% debentures in our original balance sheet. As per note number 4, they were converted to 14% debentures. Now we have 14% debentures. So the value for 14% debentures, one, this 12% debentures, they were converted into 14% debentures. So what was the value of those 12% debentures? The value for 12% debentures is how much? Is basically 6,000. But also remember, as per note number 4, there were other debentures which were issued by the company having a value of 2,000. So in total, the 14% debentures will be having a value of 8,000. A value of 8,000. The ones which were issued in exchange of the old debentures and the ones which were issued for cash. Sasa? Yes. So then from there, do we have any other non-current liability which will appear here? Any other non-current liability which will appear here? I don't think so. Finally, I think what we have now are the current liabilities. Current liabilities. So in that statement of financial position which we have here, we have bank overdraft. Automatically that will not appear here because it was paid. Then we have sundry payables. Sundry payables was supposed to be paid 51.80, but remember there was part of the amount which was paid to them as per note number 8. They were paid 31.80. So the amount which they were to be paid, or the balance was how much? Was 2,000. Was 2,000. I think basically that's what we have. I don't think we have anything else. Yes. And automatically, once you balance out your statement of financial position, you should balance, but no need of getting those totals. No need of getting the totals. Which basically will be marked are these entries. These are the entries which are marked. These are the entries which will give you the marks. These entries there, not the totals there. These are the entries. The entries which are marked. Basically, the marks allocated there were 8. Now, I want us to finalize with the last part. Let's do the last part of the question. This is a very good question on internal reconstruction, a very good one, because you can see that it has so many entries, or basically so many items being tested in that particular question. So it's a very good question on internal reconstruction. So let's do the last part of the question. And basically what we are required to do is we prepare a statement showing how the anticipated profit will be distributed among the various providers of capital. In other terms, you can just refer to this as the distribution statement. Distribution what? Statement. So these are statements to show how the anticipated profit will be distributed among the shareholders. So I said the information which we have in note number 10 is what we're going to use in answering this part, together with some of the information which we have here. Can we go to note number 10? We see what we are told. We are told that it is estimated that under the new arrangement, the net profit before interest and tax will be 5 million shillings, 5 million per annum. There will be no tax liability relating to the company for the next 5 years. So basically, we are required to show how that profit will be distributed to the various providers of capital. So whatever you have there in note number 10 is basically profit before interest and tax. The profit before interest and what? And tax. How much is that? It is basically 5 million. 5 what? 5 million. So the first thing we need to do to this profit, because it is a profit before interest and tax, the first thing we need to less is the interest. Remember, this is the interest, or basically the finance cost. The interest or the finance cost to be paid to the providers of capital. So what we need to do is basically go back to the balance sheet of a company, specifically at the non-current liabilities, and we see providers of the non-current liabilities. These are the providers of capital who should be paid. So the company has got issued 14% debenture. So how much interest will be paid to these debenture holders? They'll be paid an interest or a finance cost equal to 14% times the value of those debentures, 8,000. 8,000. So this will give us how much? This will give us how much? This will give us an amount of 1120. So then from there, we will get the profit before tax. The profit before tax. So how much will be our profit before tax? 5,000 minus 1120. It will be 3880. 3880. So that is the profit before tax. Then what you're told in note number 10 is that this company will not pay tax in the next 5 years. So no tax will be paid. So meaning here, we don't have income. We don't have what? We don't have income tax expense. So the income tax expense will be nil. So meaning that the profit for the year, will be this, will be that amount. But basically what we know is that this profit for the year, and that is something we came across in the topic of EPS. So this is now what the company is in terms of paying dividends. Sasa, this is what the company is in terms of paying what? Dividends. We also know that if a company has issued ordinary shares and basically the preference shares, the ordinary shares and preference shares, we know from what you did in company law that the preference shareholders should be paid dividends first. Is that what we know? That the preference shareholder should be paid dividend first before the ordinary shareholder. That's basically what we know. So therefore, what we need to do here is basically to raise the preference dividends. The preference dividend will be 15% of the amount of preference share capital, which is 6,000. 6,000. So that will give us a preference dividend of how much? Preference dividends of how much? 15% of 6,000. Yes, that will give us 900. 900. So we less it from that value. And then we get an amount of what? We get an amount of 29.80. Now, this 29.80, remember, in the topic of earnings per share, we were referring to this as PATOS. This is now what we refer as the PATOS. This is the profit which is attributable. The profit attributable to whom? To ordinary shareholders. So this is the profit attributable to ordinary shareholders. So the company will use that to pay dividend to who? To the preference, not to the preference, rather to the ordinary shareholders. And basically that's what was required in Roman 2. Basically not Roman 2, but part C of the question, the distribution statement to show how that particular anticipated profit will be what? Will be distributed out of not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the lease for how many years? Is the lease for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Peri Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes. In arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin. There was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amount are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest factor of annuity at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N would be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. That's huh? Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Sasa, yes. So let's work out this. And I think in our case, we already have this value. We already have this value. Remember, we said in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n. We divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you're told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n. That is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. That's huh? Yes, we multiply that with 50. So what would be our lease liability here? What would be our lease liability? What would be our lease liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610. 428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure like that. Yes. So that basically would be the lease liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this lease liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the lease amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum lease rentals are payable at the end. So take into account our lease is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, and 30th of November 2024. So then the next column here should be for the lease liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum lease rentals were payable in advance, so after the lease liability, the next column should be forward for the cash paid, for the minimum lease rentals paid, if this one was payable at the start. Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum lease rentals, paid. And finally, we have the lease liability at the end of the year. So that's basically how we arrange our lease, the lease amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum lease rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the lease liability, and actually how we do what we present this. So in case the minimum lease rentals is payable at the end, so after the lease liability at the start, what comes next is the interest, and then the minimum lease liability. Yes. So what we start with here is basically the lease liability at the start of year one, and that is basically what we have computed there, which is basically an amount of 4610 for 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum lease rentals, which was paid at the end of year one, is this one, 1550,000. So this one, we said it reduces the value of the liability. So to compute the lease liability at the end of year one, we will take this one, lease liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the lease liability at the end, we are taking this one, the lease liability at the start, we are adding this one, the interest paid, we are raising the minimum lease rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Yes. So let's work out that. So we add 4610 428.5 minus 1550. Yes, and basically here I'm getting what? I'm getting 36, 59, 784, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. To the nearest whole number, to the nearest whole number, to the nearest whole number, to the nearest whole number. This one should be 9. Let's work with that as 9. To the nearest whole number should be that. Yes. So that will be the opening balance here. 3659, 785, So we compute interest, which is the 13%. 13%. Basically, I'm getting 475, 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the lease liability at the end of year 2. So we have 36, 59, 785 plus the interest for 75, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336, 122. The amount paid is 1550,000. Yes. So let's work out the lease liability at the end of year 3. We have 25, 85, 557 minus 155. Yes, and basically here I'm getting 13, 71, 679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance there. And then we compute the interest as 13%. 13%, and basically I'm getting 178, 318. So the amount paid there is 1550,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178, 318. Yes, 1371, 679 plus 178, 318. Yes, so I hope you can see this coming for around 3, but essentially should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular lease amortization schedule, basically to amortize our lease liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets. And basically the right of use asset, equally we compute this at the inception date of the lease. Remember, the lease commenced on 1st of, this one should be December. It should be December, 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the lease liability. The lease liability at the inception date, and basically that is the inception date is 1st December 2020. So, and the lease liability at the inception date is what you have computed here, 4610, 429. To this we said we add any payment made at the inception date, of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 429, 570. So we add those two values and we get now something called the right of use asset. the right of use asset. So the right of use asset will be 4610, 429 plus 429, 570. And basically, we get what here? We get 50. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then, the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this right of use asset should be depreciated on a straight line basis at the shorter of two periods. At the shorter of two periods, the shorter of two periods, the shorter of two periods. Number one, the lease term. The lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the two period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight line basis for 4 years. So to compute the depreciation per annum, we will take the right of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. Divided by 4. And basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what was required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to this risk. So we start by preparing the income statement extract. We start by preparing income statement extract. Income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest. And actually, we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually, we are going to prepare this for these 4 years here. The first year ended that year's November 2021. That year's November 2022. That year's November 2023. That year's November 2024, like that. 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remains the same for 4 years. 1256,000. 1256,000 fair. 1256,000 fair. Yes. So that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What hand you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you have prepared these financial statement extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. Extract. Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement of financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. That will give us 1260. The 1260, yeah? To the nearest whole number, David. It has 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. Forward for year 2. No, you don't need to show that as provided you have recorded that as expenses. The person who is marking that will be in a position to see that those are expenses, provided they are under expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year 2, we also less the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25,19,999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into 2. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2 we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as an uncurrent liability is this one. So which is 25,85,557. In year 2 is what we have here, 13,71,679. In year 3 is basically 0, and also in year 4 is 0, like that. So, yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year, and therefore we say we take the decrease, because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David, the writer, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year 2. Year 2, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one, minus 13, 71, 679. So basically that will give us an amount of 12, 13, 878. Yes. And then now in year 3, we get the difference between this. Remember, the lease liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the lease liability is what? Is 0. And the lease liability there is 0. The lease liability there is what? Is 0. Is what? Is 0. So that is it. That what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the lease liability, how we compute the right of use asset, how we prepare this particular lease amortization schedule whenever the minimum lease rentals are payable at the start of the year and also at the end, because that is the question we are likely to come across. The minimum lease rentals are payable either in advance or in arrears. You must be in a position to compute the lease liability to prepare this one and the right of use asset. Yes. So basically that is it. That what was required as far as that question is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of leases, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is, can you try to check on how the leases are accounted for by the owner of the asset? The owner of the asset, or basically the lessor, try to remind yourself how that particular person accounts for the leases. Account for the leases. Account for what? For the leases. Account for what? For the leases. Okay. So we have that. We have another small question here. So basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IS 32, the company should split the two components. The company should split the liability component and the equity component. There is equally a question here I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this. Yes, equally, I've shared that question in the class WhatsApp group. I've shared that question in the class WhatsApp group. I hope it is clear. I hope it is clear. Is it clear? Whatever I've shared in the class WhatsApp group. Is that question clear? Yes, I hope it is. I hope it is. I hope it is. But before we look on that, can we just take a short break of just like 8 minutes? We come back at 9:10, so that we continue with that question. So we just take a short break of 8 minutes, and then we come back up after that short break of 8 minutes. We come back at 9:10. Yes, so I want us to continue. I hope you're back. I hope you're back. So let's look on these that questions here. Let's look on that particular questions here. So the question reads, that Good Limited issued shilling 4 million 7% convertible bonds on 1st January 2019 par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary share for shillings 10 of the bond held. So we are told the prevailing market rate on 1st January 2019 for similar bonds without conversion rights was 9% per annum. And then you're told that all the interest in the year to 31st of December 2019 has been paid. So what are we required to do here? We are required to calculate the amount being included in the statement of financial position of Good Limited in respect of the convertible bonds on 31st of December 2019. So now we say that if you happen to come across this question and you see the word convertible, if, for example, you're told a company issued a debt instrument, and that debt instrument issued by the company happens to be convertible, then we say what you need to remember very fast is that this is a compound financial instrument. This is a compound financial instrument. Remember, we said a compound financial instrument. We said that this is a hybrid financial instrument. In fact, in other terms, it can be referred as a hybrid financial instrument. It's a financial instrument which contains both equity component and the liability component. It contains the equity and the liability component. And we say once the company has issued such a compound financial instrument, as per IAS 32, the company needs to split the two components, the liability component and the equity component. We look from the steps to be followed. First of all, we said we compute the liability component. Number two, we compute the liability component. So what I want us to do, let's go straight to that question. We go straight to that question. Equally, this is a question I've borrowed from the paper for CIFA, financial statement analysis. So this, I think, was from which sitting of CIFA? This one from the sitting of November 2020. And this specifically was question number 5A. Question 5A. So we are told this company, which is called Good Limited, our company did what? Issued. The company issued 7% convertible bonds. So take into account we have the word convertible. I'll say that this one is a compound financial instrument. Yes. So therefore, that is very important. That if you happen to come across maybe a question and you're told a company issued some debt instruments and which are convertible, like convertible bonds, convertible loan stock, convertible debentures, you need to remember that that is a compound financial instrument. So therefore, this we can say this is a compound financial instrument, and they should be accounted for. Should be accounted for in accordance with what? In accordance with International Accounting Standard number 32. Remember, I said this standard, International Accounting Standard number 32, basically requires that once a company has issued a compound financial instrument, the company should split the two components, the liability component and the equity component. So the first thing we do is to compute the liability component, and then from there we proceed and we compute the liability component. So therefore, step one is basically to compute the liability component, component. And actually, we compute this liability component on the date of the issue. When were these convertible bonds issued? We are told in the first paragraph they were issued on 1st of January 2019. 1st January 2019. 1st January 2019. So we say that this liability component is equal to the present value of the annual interest, the present value of the annual interest plus the present value of the principal payment. And actually, you cover similar concept in FM. For example, like when computing the value of debentures, the value of the other debt instrument. Usually, this is a concept you use. You discount the interest to be paid on annual basis and also the principal amount. These basically no much difference with what you do in financial management. Whenever you're required to compute the value of maybe a debenture, the value of a bond, I think it's basically what you do. So what we need to do here is first of all, we compute this one, the annual interest. So we say the annual interest, in other terms, the interest per annum. How do we compute this? We say the formula is very important because we say that in these questions, you'll be given two rates. You'll be given two interest rates. Which interest rate do we use? We use this one, the coupon interest rate. The coupon interest rate, we say, is the interest name coming before the name of the compound financial instrument. Like the compound interest rate is 7%, and then you multiply that with the par, the face, or in other terms, the nominal value of what? Of the compound financial instrument. So therefore, in our case here, the coupon interest rate, I've said is the interest rate which is given before the name of our CFI, which is 7%. And then still in the first paragraph, the first sentence, we're told the good limited issued shillings 4 million, 7% convertible bonds on 1st January 2019 par value. So meaning that 4 million is the par value. 4 million is the par value. Remember, this par value can also be known as the face value, can also be known as the nominal value. The examiner may use any of the words here. Yes. So this will give us shillings 280 million. And remember, this will be paid per annum. This one will be paid per annum. So we already have this. So then from there, we need to determine the principal amount. In this case, we say the principal amount. This is the amount payable on redemption. So once these particular convertible bonds mature, how much amount will be paid on redemption? So that information, we have it within first paragraph, the second sentence. We are told the bond is redeemable at par. That is very clear. The amount to be paid on redemption, this one is equal to the par value. So in our case, remember, we know the par value is how much? Is 4 million. So this is the amount to be paid on redemption, and we must be given the date when they will be maturing. So these convertible bonds, they have a life of how many years? So we are told they will be redeemed at par on 31st of December 2023. So that is the redemption date, and basically that will help us in terms of knowing the life of these convertible bonds. Remember, they were issued on this date. 1st January 2019, we are told they will be redeemed on 31st of December 2023. How many years do we have here between those two dates, between the dates they were issued and the redemption date? How many years do we have there? How many years do we have there? We have the first year, which will end 2019, and 31st of December 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. 2019, 2020, 2021, 2022, 2023. Are those 5 years or 4? They were issued on 1st January 2019. Are they 4 or 5 years? Remember, in this case, the year is supposed to end on 31st of December. Kuna 2019, 2020, 2021, 2022, 2023. Those are 5 years. So the life of these both in 5 years. And remember, in this case, we said, when computing this liability component, we assume that the holders will not convert them into ordinary shares. I think we say that is an assumption which we make. That's why you check on that question. There is somewhere we're given information about how they can be converted into ordinary shares. There is nowhere we use that information here, because we say for us to be able to compute the liability component, we assume they will not be converted into ordinary shares. That's why that information about the conversion, we don't use it here. So we say to discount this, there are two approaches you can use. Remember, this company here, which issued these bonds, which have a life of 5 years, the life of 5 years, our company is expected to pay this amount per annum. To each will be paid at the end of each year. And automatically, this interest is always payable in arrears. This one is payable in arrears. That is the amount to be paid per annum. That is an annuity. And then at the end of year 5 here, the company will also pay this amount of 4 million. So we said to discount, you can either prepare, for example, a table here from year 1 all the way to year 5, and then you have this amount to be paid. Here you have to 80,000, year 2 to 80, year 3 to 80, year 4 to 80, but year 5, we will have to 80,000 plus 4 million. And then you discount this by multiplying that with the present value, interest factor, and which rate do we use in discounting? When discounting, do we use this 7%? No. In discounting, we say we use another rate which is known as the effective interest rate or the market interest rate. And I hope you can see that within the last paragraph. We are given the prevailing market interest rate of 9%. So at the rate of 9%, you get those values, you multiply this with this, you get the present values. Alternatively, we said, because this is the 280 is an annuity, so to discount that to 80, we will take 280. We multiply that with the present value interest factor of annuity at the rate of 9%, and basically for 5 years. Then this 4 million, these are lump sum which will be paid basically at the end of year 5. So we multiply that with the present value interest factor at the rate of 9% and basically for 5 years. Remember the formula for getting PVIVA, and this one is different. So here we have 280. So the formula for getting this is what? 1 minus 1 plus R, which is 1.09, raised to power negative 5. We divide that with R 0.09. That is how we compute that PVIVA. And then we add this 4 million. So the formula for getting this is 1 plus R, which is 1.09, raised to power negative 5 by such. Sasa, yes. So let's work out this. We start with what we have here, the PVIVA. So we have 1.09 raised to power negative 5. So 1 minus answer divided by 0.09. That will give us 3.89. Okay, I think we multiply that directly with 2.28,000. And this will give us 10.89. 102. That is basically what I'm getting here. What about this one? 1.09 raised to power negative 5. Is that correct? Can you confirm whether you get that? Yes, so raised to power negative 5 times 4 million. And basically that will give us 25.99, 726. 726. Yes, so we add the two values. And I'm getting a value here of 36, 88, 820, 828. That is basically the value I'm getting here. You can confirm whether you get the same. Confirm whether you're getting the same. Are you getting the same? Yes, are you getting the same? Are you getting the same? Yes. So that is the what? That is basically the liability component. The liability component. The liability component. Now, having computed that liability component, step number 2 is to compute something called the equity component. The equity component. And actually, we also compute the equity component on the same date. Effect of the revaluation in note number 2. Income tax applicable to this company or to this bank is what? Is 30%. Now, that information which are given there is basically to help us to compute something called the deferred tax. The deferred tax. So meaning that in our case here, we don't have any over or basically what? Other provision. So now what you're told from sentence 2 is that the carrying amount of this bank's net asset exceeded the tax base with an amount of 1,800 billion. So we said the first thing you need to recall is the name given to this difference. The name given to the difference between carrying amount and tax base. And this is something you also did in financial reporting, and you're told in that topic of income tax, in that topic of deferred tax, you're told any difference between the carrying amount or the difference between carrying amount and tax base of asset liabilities or basically net asset, that one is called temporary difference. Temporary difference is the difference between carrying amount and what? And tax base. And equally, you are told that we have two types of temporary difference. We have the taxable temporary difference. We have the deductible temporary difference. That is something you need to recall. Now, a temporary difference we say is taxable, whereby the carrying amount of the net asset exceed what? The tax base. And basically this give rise to something called the deferred tax liability. So anytime you come across a question and basically you told the company had a taxable temporary difference, you need to compute the deferred tax liability. Remember, these are tax to be paid in the future. How do we compute this one? We take the taxable temporary difference, this one, and basically multiply that with what? With the tax rate. Now, on the other hand, a deductible temporary difference arises whereby the carrying amount is less than the tax base. Remember, this should be tax base TB than the tax base. And basically, this give rise to something called the deferred tax asset. How do we compute the deferred tax asset? We take the deductible temporary difference times what? Times the tax rate. So therefore, what we are expected from this, from that point, is for us to determine whether this amount here, which you're seeing is a temporary difference, is it taxable or deductible? In our case, because the carrying amount is more than the tax base, automatically is what? Taxable. So taking into account it is taxable, we will use this to compute something called a deferred tax liability. But still, there is something which you are told in that particular point number 3. I think it should be sentence number 3. We are told this carrying amount which exceeded the tax base with 1,800, this carrying amount does not include the effect of the revaluation in note 2. Remember, once the company revalue assets, that does not affect the tax base. Remember, tax base is the value we use to compute the value of an asset used in taxation. So the value of an asset usually in taxation is always based on the cost. If you revalue an asset, does that affect the value used in computing the carrying amount? Not the carrying amount, sorry, the capital allowances? No. So we compute the capital allowances, which is a allowable expense in tax using the cost. So, but anytime you have revalued an asset, that affects the carrying amount, the value at which an asset is recorded in the balance sheet. So therefore, these particular assets which were revalued upward, definitely that was supposed to increase the carrying amount. But we are told this particular difference which are given here does not include this increase in what? In the carrying amount. That's why we say we will take this particular amount by which the carrying amount exceeded the tax base, and then we have to add this because this one was not captured in computation of this. So therefore, the correct figure for the company's taxable temporary difference will be 18 million plus what? Plus 650. Plus what? 650. And this was giving us 24 what? 50 million. So this is what? These are taxable temporary difference. So what we need to do is to compute the deferred tax liability. So the deferred tax liability would be equal to the taxable temporary difference times the tax rate. So the taxable temporary difference is this one, 2450 times what? The tax rate, which is 30%. So what would be the deferred tax liability at the end of the year? The deferred tax liability at the end of the year, yes. So that one would be 735 million. Now remember, in preparing the statement of financial position, this is basically what we recognize there, and this is a liability. The deferred tax liability is what? Is a liability. But now there is also something we need to do. We need to prepare a deferred tax account so that we determine the amount of deferred tax to be charged in the income statement. So how do we prepare the deferred tax account? We are going to use certain basically a number of items from here and also from the balances we have below paragraph 1. So this is the deferred tax account. The deferred tax account. Now, what do we start by recording here? Remember, whatever you have here, this is the deferred tax at the end of the year. This year ended basically on 31st of March. 31st of March 2022. That is the deferred tax at the end. That's why we are saying that what we are going to recognize as a liability in our balance sheet. Now, when preparing this account, we always start by recording the deferred tax at the start. Now, if we go back to the balances we have below paragraph 1, somewhere in the middle there, we are given the deferred tax at the start. Can you see the deferred tax from those balances we have below paragraph 1? We can be able to see that item of deferred tax. Yes, can you be able to see that deferred tax? The deferred tax? Yes. Deferred tax, somewhere in the middle there. Yes, the deferred tax of 370. And actually, in this case, you can see the question is hidden, whether it is a liability, whether it's an asset. If you're given a deferred tax, the question is hidden, then we always assume it is a liability. So this one we treat it as what? A deferred tax liability. Being a deferred tax liability, we will record that as the opening balance here on the credit side. Remember, all liabilities have a credit balance. I've said if the question is silent, you assume it is a deferred tax liability. It is a deferred tax what? Liability. Now, after recording that, what else do we record in this particular account? The other item we record in this account is the deferred tax at the end of the year here. Now, this being a deferred tax liability, the balancing figure or the balance carried down should be recorded here. Such that after balancing our account, because this one is a liability, the balance brought down will be a credit balance. Remember, this one is a liability. Yes, but carried down should be on the debit side if it is a deferred tax liability. If it is a deferred tax asset, carried down should be on that side. Now, what else do we record here? The other item which we record here is this item here, 185. We said 185 will be credited in the deferred tax. And that, remember, is the deferred tax on revaluation gain. On revaluation what? Gain, which is basically 185. 185. After recording that, if you can be able to recall what we are doing in a file, the balancing figure in this account should be taken to the income statement. The balancing figure in this what? Account. So if the balancing figure is on this side, that one we take it to the income statement, and this one we refer to it as a deferred tax expense. If the balancing figure is on that side, is a deferred tax expense. If the balancing figure is on this side, still it will be taken to the income statement. That is a deferred tax income. Is the deferred tax what? Income. And I think we will be having a balancing figure on the credit side. So what will be the balancing figure on the credit side? Should be 735 minus 370 minus 195. And basically that will give us an amount of how much? An amount of 170. So what is that? It is a deferred tax expense. Remember, being a deferred tax expense, this one together with the current tax, those two items will be deducted from the profit before tax. So from the profit, or actually once we get the profit before tax, we less the income tax expense. Income tax expense comprises of the current tax and the deferred tax expense. Sasa, yes, I think having that now we can be able to move and basically prepare what is required. Prepare what was required. So actually what the examiner did in relation to this question, he tested the student knowledge on a number of standards, because what was tested here in relation to this point is the student knowledge on International Accounting Standard number 12, income taxes. Here, the examiner was testing the student knowledge on IFRS 9, financial instrument. We will do something to do with that. We will do something to do with that. And what the examiner was testing here is the student knowledge on IAS 16. IAS 16, remember, is on what? IAS 16 is on what? Who can be able to remember? International Accounting Standard number 16, from what you did in a FA, what you did in a FAN, is on what? IAS 16. Who can be able to remember? IAS 16. Remember, knowledge on this standard moving forward now is very, very important. Equally nowadays, if, for example, you go to an interview as an accountant, you may be required to mention a number of standards. Because as an accountant, you're expected to have some knowledge on these accounting standards. Yes, it's very, very important. Even if you don't have detailed information about these standards, you need to know. For example, when we talk about IAS 16, is on what? Is on PP. When we talk about IAS 12, is on income taxes. So these are some of the questions you're likely to encounter nowadays once you go for interviews. Yes. So let's basically move and start with what is required in part A, and that is basically the income statement of profit or loss, statement of profit or loss, and other comprehensive incomes. Other comprehensive incomes, basically for the year, which ended 31st of March 2022. 31st of March 2022. So here we just need to have a single column, and our figures are in million of shillings. So what do we start by recording here? We start by recording the interest income. So we say this format is very, very important. We start by recording what? The interest incomes. The interest incomes by our bank. So if we go back to our question, basically we have a number of interest incomes somewhere in the middle of the balances we have below paragraph 1. So number 1, we have the interest on loans and advances to customers. So this one is an interest income. We said once you go to your bank, you take a loan, you are charged an interest. So the bank is an income. So we just say that this is the interest income from loans and what? And advances. Advances to who? To customers. So no adjustment for that, which is basically 25.75. Then below that, we have interest on government securities. On government securities, which is an amount of 264. Then we also have interest on deposit with other banks. Deposit or interest on deposit with other banks. Other banks. So basically that is an amount of 646. And then the interest on deposit from other banks. Interest on deposit from other banks. So remember this basic deposit which is held by our bank here, and those deposits belong to other banks. So our bank here, that is Delta, is paying other banks interest. So this one is an interest expense. So then we have the interest on customers' deposit is an interest expense. We have interest on long-term borrowing is an interest expense. Yes, and I think those are the only interest incomes which we have. We don't have any other. So let's get the total interest incomes. The total interest incomes. Total interest incomes. We get an amount of how much here? $54.85, like that. Yes. So and then to this now we proceed and we less the interest expenses. The interest expenses. Interest expenses. Now for the interest expenses, equally we have a number of interest expenses. We start with where we have the interest on deposit from other banks. So the interest on deposit from other banks. Deposit, interest on deposit from other banks. From other banks. So basically that is an amount of 662. We record that here as a negative because we will deduct that from that total. So below that we have interest on customers' deposit. On customers' deposits. customers' deposits, which is basically an amount of 1833. Then from there, we have the interest on long-term borrowing, borrowing. So that particular interest is an amount of 1385. But remember, we say that this particular interest on bonds, remember bonds is a form of a long-term borrowing. Anytime a bank issue bonds, that is a form of long-term borrowing. So the interest on these bonds basically will have to be included here. That is this interest of 54. We also include it as part of interest on long-term borrowing. So we add 54 there. We add what? 54. And that will give us a total of 19 what? 1939. 1939. After adding the interest on both, are we getting that value? 1939. I've taken the interest on long-term borrowing, 1385, plus this interest on the board. I've said the board is a form of long-term borrowing. Yeah? Yes. So I think that would basically have. We don't have any other interest expense. I can't see any other interest expense. I can't see any other. I can't see any other. So what we get here is the net interest incomes, or net interest income. Net interest income. So we take whatever you have here, we less those three interests, those three interest expenses. We less those three interest expenses. What do we get? What do we get, John? What do we get, Timothy here? What do we get, Henley? Charles, what are you getting? 1551. 1551, yes, 1551. So after getting that in net interest income, we said we proceed and we add the non-interest incomes, the non-interest incomes, non-interest income. So the non-interest incomes, these are basically other incomes by the banks other than the interest incomes. And long-term borrowing is not correct. Which figure are you saying is not correct? Is that the figure for 1939? Huh? Oh, okay. So it should be 14. Okay, sawa. But I hope this one is correct. But I hope 1551 is correct. Okay, sawa. Thank you. So which non-interest incomes do we have? So I think we can get that from where we have below the interest incomes and interest expenses. We have administrative expense, other operating expenses, and then below that we have fees, commission, and foreign exchange incomes. So we have fees, commissions, and forex incomes. So remember, you say these forex exchange incomes. This is basically the profit which the bank, the income the bank gets from buying and selling foreign currencies. We refer to that as foreign exchange income. And I don't think we have any other than that. I can't see any other, including up there. I can't see any other. I can't see any other. So we get the total incomes, and then we less the non-interest expenses. Non-interest expenses. So this will give us a total of 7641. Then next we less the non-interest expenses. Non-interest expenses, I think above this, fees, commission, and foreign exchange incomes. We have two expenses. That is two non-interest expenses. So we have administrative expenses. Administrative expenses, which is an amount of 2160. And then we have other operating expenses. Other operating expenses. And the other operating expenses is basically an amount of 1163. 1163. I can't see any other. I can't see any other, including what we have in the additional information. Yes. So let's get now the profit before tax. We get the profit before tax. The profit before tax. What will be the profit before tax here? 4318. 4318. That is the figure I'm getting. That is the figure I'm getting here. Someone to confirm whether that figure is correct. Okay, sawa. Now to this, we need to less the income tax expense. The income tax expense. So the income tax expense, this comprises of two components of tax. Number one, this comprises of the current tax, which we have here, basically note number 3. Note number 3. So this one, 890. And basically someone may ask, within the balances we have below paragraph 1, there is somewhere we given installment tax paid. I don't know whether you can see that. There is somewhere we given installment tax paid just above the deferred tax. Now, this installment tax paid, generally, I hope you know how companies pay tax. Company pay tax not at the end of the year, but basically a company should estimate the tax to be paid at the start. There is some guideline issued by Revenue Authority on how to estimate the tax to be paid in a certain financial year. That tax has to be paid in 4 installments. In 4 what? Installments. So therefore, like this, the tax for 2022, most of it basically was paid within the current year. Like 3 installments were paid during the current what? The current year. The remaining installment will have to be paid in 2023. So therefore, that installment tax paid will help us in terms of determining how much tax has not been paid at the end of the year. So you can see our company here was supposed to pay a tax of 890 during the current year, because current tax is the tax to be paid in relation to the profit for the current year. In relation to the profit for the current year, yeah, this is the tax which is supposed to be paid by the company during the current year. But now, at the end of the year, our company had paid installment taxes amounting to 360 million. Amounting to 360. So the difference here, this is the tax not yet paid. Or in other terms, you can say it is accrued what? It is the accrued tax. Being the accrued tax, this one will be a liability. This one will be what? This one will be a liability. That's that? Yes. So what I'm saying is that companies do not pay tax once the year comes to an end. So a company should estimate the tax will be paid at the start of the year. And then that tax has to be paid in 4 installments. I hope this is something you know from tax. So that's why I'm saying during the current year, our company was supposed to pay a tax of 890, but when the year was coming to an end, out of this 890, the company had already paid 360. So what we account for here is not the tax which had been paid. Remember, when preparing the income statement, we prepare this on accrual basis. Whatever you capture here is the expense for the current year, not what was paid. The expense for the current year. Our company was supposed to pay 890. That's what we capture here. But when the year was coming to an end, the company had already paid 360. So the balance, which is around 530, is the current liabilities, what had not been paid. That will be paid in 2023. We will account for that as a liability. That's that? Yes, but basically what we account for here is the tax for the year. I hope that point is clear. I hope that point is clear. Now having that, we can proceed, and basically we also account for the deferred tax, because I say that this income tax comprises of the current tax and what? And the deferred tax expense. The deferred tax expense is what we computed here, this particular amount here, the amount of 170. The amount of 170. So that is basically what we captured here. And then we get what? We get the profit after tax. The profit after tax. So how much will be the profit after tax? The profit after tax. $32.58, yes. So after getting that, we proceed, and basically we add other comprehensive incomes. Other comprehensive incomes. So remember, other comprehensive incomes, these are the other incomes which should not be part of this profit, they should be added to the profit after tax. Yes. So, and I think in our case, we only have one item, this revaluation gain, but we said we will record it here, we will recognize it here net of deferred tax. And I think we computed that amount to be recognized here, and it is that amount. So we have the revaluation gain on property, plant, and equipment, which was basically 650, but we deducted the deferred tax. So this one, therefore, will be recognized here net of deferred tax, 455. So we don't have anything else. We get the total comprehensive what? Income. Total comprehensive income here will be 3. 1. We should get 7. That is 7, 13. That is 7 what? 13. That is 7, 13. Yes. So that is it. That basically what is required as far as that question is what is concerned. Now, because of our Muslim brothers, I want to give you a short break of just 10 minutes. We come back and then we finish on what is remaining. We just take a short break of 10 minutes. We come back and then we prepare the statement of financial position. Sasa? Yes. So we take that short break. Yes. So I want us to continue. I hope you're back. Let's continue. Let's continue. Are you back? Are you back? Are you back? Are you back? Please confirm whether you're back. Okay, sawa. So let's finish basically by preparing what is required in part B. So in part B, we are required to prepare the statement of financial position. So this one basically we record assets, liabilities, equity of the bank, and always we start by recording the assets here. So this will be our part B, our statement of financial position. And basically this is at 31st of March 2022. 31st of March 2022. Yes, so we start by recording assets. And remember, in this case, we said when recording assets of a bank, we don't classify them. So the rule is that we should record these particular assets in the liquidity order. We start with those assets which are either liquid or highly liquid. And finally, we record those assets which are least liquid. They cannot be converted into cash within a short period of time. So that is basically the rule here.